Good morning, folks. I think we are going to get underway. I want to thank everybody for being here today. This is a great turnout. I also want to take a moment to acknowledge our online viewers. Today's event is being webcast live and will be archived, of course, on the New America website. But I want to say welcome to all those folks who are watching at work or at home right now. I'm Justin King. I work in the asset building program at the New America Foundation. I also want to start by thanking all the people who've helped bring this event together. Our partners at the Center for Financial Security, Michael Collins and his team have been terrific. Pam Chan on our team has put a ton of work into this event. And I really want to take a moment to thank the sponsor of this event, the Congressional Savings and Ownership Caucus. The co-chairs of the caucus are Representatives Jim Cooper, Tom Petri, Nikki Songas, and Joe Pitts. Without them and the work of their staff, we wouldn't be here today. And I think it's safe to say without them and the work of their staff, the landscape of sort of savings and asset building opportunities for Americans writ large would be different than it is today. The caucus is a bipartisan group that's dedicated to exploring, debating, and advancing policies to build savings and assets for all Americans, particularly those Americans with lower incomes and fewer resources. Their vision is of a nation in which all Americans are owners of financial assets and thus better able to exert control over their own economic futures. Since the caucus began in 2005, they've examined a variety of issues related to savings and ownership. It relates very closely to our work in the asset building program, which is focused on significantly broadening access to economic resources and increased savings and asset ownership, providing families with enhanced economic security, greater resiliency, and the means to pursue their aspirations. The events of the last few years really drive home that these issues are more important now than ever before. Our topic today is rebuilding the road to financial stability. Now, there's been a great deal of talk in Washington about trying to repair the nation's fiscal status. I want to apologize to anyone who's here thinking that this is the conversation that they're going to be listening to today. If you leave now, you might be able to get a good seat at the White House for the President's press conference later today. That might be more informative for you. Our focus is not on the nation's fiscal house directly, but we wanted to take time to focus on ordinary families struggling through a very difficult period in our nation's history, trying to keep their own fiscal houses in order. When you look at household economics over the course of the last 30 years, there are some stark trends that emerge. One of the first ones that jumps out at me is that the personal savings rate has declined significantly and consistently from the early 1980s leading into the financial crisis. As a matter of fact, shortly before the financial crisis, the personal savings rate registered close to zero for the second time in our nation's history. The first time was right before the Great Depression. So it makes me think this is a leading indicator of very bad things and something that we should pay closer attention to. The other notable trend is the rise in household debt. In 1989, the median household debt was $24,000. In 2007, that had risen to over $67,000. Those two elements, savings and debt, which really is a way of expressing credit, are essentially in constant tension with each other. We see hardworking families struggling to manage that tension, juggling a portfolio of emergency credit and precautionary savings products to help make ends meet. Unfortunately, for lower income Americans, and really up the income ladder, this is a juggling act that often doesn't end well. Too many times the savings and credit options available end up eroding the household balance sheet because of mismatches in product choice or product design. According to a survey released last week by Bankrate, 24% of Americans have no emergency savings. Nearly 45% of Americans don't have enough savings to get by for 3 months if they lost their job. Unfortunately, that's not a hypothetical situation anymore. It's happened to too many people, and we've seen what happens when families are caught unprepared for a shock in their incomes. The results are bad, not just for those families, though they are bad for those families, but they're bad for neighborhoods, it's bad for cities, states, and indeed the nation as a whole suffers when families are caught unprepared. If those families were to have a nest egg of savings to call upon in times of need, it would reduce their financial instability, reduce the hardship that those families face, reduce the stress that they feel, and be better for their communities, their states, and the nation as a whole. Without savings, those families often have to rely upon costly financial services to meet their immediate needs, and the end result is a downward spiral of financial instability. So our focus today, how can we better help families to be prepared to handle events that are unforeseen but inevitable? How can we help families to become more resilient economically? How can we get more Americans on the road to financial stability? First, we have a panel of experts that are going to survey the condition of that road and tell us what tools families use to get by, and whether those tools and where those tools are working and where they're not working. That panel is going to be led by Michael Collins from the Center for Financial Security, and I'll let him talk more in depth about the individual members of that group. Our second panel today is going to feature thoughts on how to improve the condition of the road to financial stability. Where has the government and the market failed lower income Americans? And what steps can be taken by policymakers and business leaders to help provide appropriate products and services? My friend and colleague Ray Bashara of the Federal Reserve Bank of St. Louis and the New America Foundation will lead that discussion. And I'm also very excited to have our keynote speaker here today. Governor Sarah Bloom Raskin of the Federal Reserve Board of Governors will be here to share her thoughts on the challenges of facing lower income Americans. We're very much looking forward to her remarks. I want to remind everyone that all the most relevant papers and publications to accompany today's discussion are available at the handouts table outside. They're also available on our website, assets.newamerica.net. And I want to thank you all again for being here today. It's a pleasure to have you. And without further ado, I'll turn it over to Michael Collins.
Well, thanks very much. I thank you all for being here today and for filling the room on this topic. I understand there are important issues from a macro level, but I think these micro level issues of consumers and households are equally important as well, and so thank you for being here. Again, I'm from the Center for Financial Security. I'm at the University of Wisconsin in Madison. We are one of the Social Security Administration Financial Literacy Research Consortium sites. So we do a lot of work around how people save, how people generate assets, and how people manage their debts over their entire life course, and ultimately how that results in financial security, including financial security in retirement. So we have been very focused on many of these issues around savings, credit, debt, and particularly been very interested in the issues that face vulnerable populations, low-income households, people from underserved neighborhoods, and who otherwise may be struggling because of the access to financial institutions, because of the information they have available to them, and other barriers that they may face. We today in this panel are going to talk specifically about the whole issue of emergency savings, precautionary savings, small amounts of money that help people get by when there's a shock. And so you hear this term shock probably a lot today. It could be an income shock, lost over time. Spouse lost a job. Both spouses lost a job. So something that results in less money coming in. It could be an expenditure shock. It could be the car breaks down. A house needs repair. An appliance breaks down. An expected but quite high expense comes along, like a cost of schooling for a child, something like that. So these are all issues I think that all of us confront and all of us face on a regular basis, maybe not always predictable, but can be particularly problematic if you're on the brink, if you don't have the savings, if you don't have the accessibility of various forms of liquidity. So we're going to talk today about, for all populations, but especially for vulnerable populations, what happens when it's not there, and to what extent does that explain what we've seen over the last few years. It's about savings, it's about credit. Ultimately, it's about liquidity. It's about having access to something to make ends meet when the time comes. We are not here to talk just about the academic research. We're here to talk about implications for policy and implications for practice. The next panel is going to talk more about policy, but you'll notice in the talks today, these are not academics talks. These are not going to be long talks. We really want to get into some discussion, some interaction with each other, and interaction with you, to talk about three important things. How do consumers behave? What are the behavioral impediments that keep us from having the amount of savings, the precautionary savings, the emergency savings that we need? What are some of the, second is the institutional barriers. What is it about the structure of financial services, the structure of accounts, the structure of the services that are available in communities that create impediments for people having these basic kinds of liquidity mechanisms available to them? And then finally, policy issues. To what extent do policies impede people's ability to build and retain small amounts of savings? So I think these are all important issues, and hopefully we'll get into those with you and with our panel today. I'm actually going to introduce all of our panelists and just let them come up. They're only going to give you, 5 or 6 minutes of sort of overview, and then I'll come up and we'll hopefully moderate a discussion together. We're going to hear from May Watson-Groth from the Financial Clinic in New York City. May is probably one of the shining stars in the asset building world, I would argue, has developed an incredible organization in a very tough environment in New York, and has a lot to share with us about, on the ground, what do we see? What are the very, very low-income people that she sees coming in her door facing on a daily basis, and what does this issue of liquidity or lack of liquidity have to do with that? Signe-Mary is from the Urban Institute, is an outstanding researcher for a long time on lots of issues of low-income populations and asset building, has done some very recent work that's very, very relevant to this topic, and so we'll hear a bit about it as well. And last, Danny Schneider, who he reminded me today that he's a graduate student, which I don't buy, because he's been such a star in the research field in this arena for such a long time. I can't believe he's actually, going to, go on and not be a graduate student. He's going to be something incredible after this, I'm sure. So he's done some great work with some co-authors he'll talk about in a minute about this whole idea of financial fragility. I think all of these will sort of help us understand sort of the baseline of where we're at, and I think lead to some greater discussion down the way. So with that, I think I'm going to turn over to May.
Good morning. Thank you. It's lovely to be here on such a stunning morning in D.C. Many thanks to the New America Foundation, Michael's Center for Financial Security, and the Congressional Savings Caucus for the invitation and the opportunity to share with you the Financial Clinic's mission, which is financial security. Fantastic. Thank you. We are very outcomes oriented at the clinic about what we mean by financial security. We track quantifiable results around assets, banking, credit, debt, and taxes. We believe that these are the 5 pillars of financial security for everyone, regardless of income, but we do primarily serve working poor New Yorkers. And so what that means is that we're looking at people's consistent savings, their credit scores, we're working on their debt loads, we're also focused on their banking account attachment, as well as their use of a tax refund for a financial goal. In addition to financial coaching, we also work on a range of more financial education and light touch services like tax preparation, free tax preparation, and FAFSA preparation, all the way through legal services around personal financial issues, including bankruptcies and mortgages, consumer credit issues, and of course tax. The value of these outcomes we've calculated to be about $2.5 million. And including our tax work, that brings it to over $10 million in about 5 years. So what does this mission and our accomplishments look like on the ground? A working poor New Yorker, our average customer earns about $17,000 a year, is referred to us through one of our 24 partners across New York City, or 311, New York City's public information line. And usually it is prompted to reach out to us because of a debt or credit crisis. 2/3 of our customers have either overwhelming debt or bad credit as their presenting issue. Our financial coach's first task is literally and concretely helping that customer make ends meet, which is a certain challenge, of course, when the self-sufficiency standard in New York is in the mid-60s. And what I mean by the self-sufficiency standard is a basic family budget. What is required to survive without savings for the future, without a Netflix subscription, and even without public assistance. And that's about the mid-60s. What the solution looks like very much depends on the problem and the resources that the customer comes with. And so we're talking about issues like health in nature, lack of employable skills, identity theft, occasionally people living, of course, beyond their means. But it also means using a predatory product like a refund anticipation loan, lack of safety nets, the inability to get unemployment or food stamps. Job loss has been, of course, an overriding theme these last couple of years. Low earnings, and even smaller, more micro issues like when an employer wants to use a credit report as a job screening device. And so the solutions look like how the financial coach is able to help our customers make ends meet. Better budgeting, patchwork jobs, doubling up in terms of housing, the use of susus, bartering, where a customer might exchange the use of their Metro card for babysitting, as an example, and then of course simply just doing without, giving up a cell phone when the debt becomes too high, even though that's the number you've given all of your prospective employers, doing without prescriptions that you might need. So hopefully that lays out a little bit of our day-to-day and what our financial coaches do with our customers. I also would like to mention and describe for you what we consider a signature financial clinic philosophy, and one that I think lends to our pretty high retention rates and our high uptake rates. The financial coaches absolutely positively address the presenting issue in those first couple of meetings and lay out an action plan to resolve it. But even in those first early meetings and first interactions with our customers, we help them also think about the future. The IRS notice that they don't understand, or the collection agency that's calling, certainly gets our customers in the door. But what gets them to do the hard work of the budgeting, the doing without, making sacrifices, is the promise of a better future. And this is made clear by the financial coach's ability to define a short-term or medium-term financial goal. In other words, the man can prompt action, but sustainable behavior change really does come from within. So from the clinic's perspective, policy can model that differentiation better, the difference between what gets people in the door in those presenting crises and what helps people sustain our relationships with them and strive for a better future. Savings bonds, courtesy of D2D's work on the 1040 is a very good example. Of course, individual development accounts are great examples, but they're not as accessible or meet needs of the vast number of our customers and the working poor people who are in and out of the labor market. We'd love to see more products, services, and better options that are short and medium term, that are easily accessed, and that are readily implemented. Thank you.
Okay, Signe-Mary McKernan, and I'm going to talk about a brief, do assets help families cope with adverse events? And I'm going to refer to some of the figures in the brief, so hopefully you all have a copy, and if not, then Jessica Compton here has a few extras. Okay. So it's a pleasure to be here today to talk about this joint brief with Caroline Ratcliffe and Katie Vinipal. The brief was funded by grants from the Casey Foundation and from the MacArthur Foundation, so we thank them for their funding. And if you step back a little bit to think about why assets are important, one of the key hypotheses is that it's to cushion negative events that might happen in life. So this brief brings some of the first empirical evidence on this hypothesis. Do assets help families cope with adverse events? And the answer you'll hear here is yes. For families across the entire income distribution, but especially for low and middle income families. So the idea is that family events, such as a job loss, a health limitation, or the death of a parent, can adversely affect economic well-being. The impact of these events may be eased if the family holds assets, like money in a savings account, and that the family then can draw on during these difficult times to cushion the blow of that event. So this study examines the extent to which families that hold assets are better able to maintain their level of consumption and have lower material hardship than families that do not hold assets when they experience an adverse event. So we use a nationally representative sample of 17,000 families from the Survey of Income and Program Participation. And then we start by looking at a family over a one-year period. First, we measure the family's income and assets at the beginning of the year. And then throughout the year, we look, did the family experience a negative event? Did they have an involuntary job loss? Did they have the start of a health-related work limitation? Or did they have a parent leave the family, either through death or divorce? And then we measure the family's material hardship the following year. Material hardship is measured with food insecurity, trouble paying basic bills, and the general deprivation index that is a combination of material hardship measures. So our first question is, to what extent do families hold assets? And what % of families are asset poor? We focus on a family's liquid assets and define a family as liquid asset poor if they don't have enough assets to finance consumption at the poverty line for 3 months without income. And what we find is that over half of families are liquid asset poor. Media asset holdings for our sample was about $3,300, and the asset poverty threshold is about $4,300 for a family of 4. What we find is that liquid asset poverty rates decrease, not surprisingly, as income increases. So we lined families up in our sample according to their income, and then we break these families into 3 groups: the bottom third, the middle third, and the top third, depending on where their income falls. And what we find is that nearly 85% of families in the bottom third of the income distribution are asset poor. 52% of families in the middle third of the income distribution are asset poor, and 21% of families in the top third of the income distribution are asset poor. Then to measure how much assets cushion a negative event when it happens, we first want to focus on the subset of families that experience a negative event. So we focus in on those families, the ones that experience one of our key events, a job loss, the onset of a health-related work limitation, and then a parent leaving a family. And then for simplicity, I'm just going to focus on one of our material hardship measures, and that is the general deprivation index. But the pattern that we're finding that I'm going to present here holds whether we look across trouble paying bills or food insecurity as well. So now if you turn to figure 3 on page 7 of your brief, what you'll see is that when a negative event occurs, asset poor families are about 2 to 3 times more likely to experience general deprivation than non-asset poor families. So for example, among those with an involuntary job loss in that first set of bars, 44% of asset poor families experience general deprivation as compared with only 16% of non-asset poor families. Well, families with more assets may experience less material hardship because they have higher income. We saw that there is a correlation between income and assets. So to help disentangle income from assets, we next separately examine the relationship between assets and material hardship for these families that experience an event by these bottom, middle, and top thirds of the income distribution. So turning to figure 4 on page 8, the next page, which gives us the same bars broken down by the income distribution. What we find is that asset poor families in all thirds of the income distribution are more likely to experience general deprivation after an involuntary job loss than non-asset poor families. So focusing on the first panel first, which is the bottom income quintile that experience an involuntary job loss, what we find is that general deprivation is experienced by 51% of asset poor families, shown in the dark bar, and 28% of non-asset poor families shown in the lighter bar. So a 23 percentage point difference. And then turning to the bottom panel, which describes families in the higher third of the income distribution, what we see is that general deprivation is experienced by 27% of asset poor families and 11% of non-asset poor families, a 16 percentage point difference. So it matters whether you're in the bottom, the middle, or the top, but it matters more. Assets cushion your blows more in the bottom and the middle. They're the income distribution. And then comparing the degree of general deprivation by asset poverty status across the income distribution shows that in general, having enough assets to live at the federal poverty threshold for 3 months is at least equivalent to being in the next highest third of the income distribution. So that's what assets can buy you in terms of cushioning blows for material hardship. So what are the implications of this? Both assets and income are important in cushioning the blow of life events. Encouraging low and middle income families to build assets by providing them incentives could help alleviate material hardship. Currently, the federal government spends over $400 billion in subsidies to support asset building. But because these subsidies are administered through the tax code, they primarily benefit high-income families. In 2009, for example, the Casey Foundation and CFED report found that over half of the $400 billion in U.S. asset subsidies went to the top 5% of taxpayers, while low-income families received next to nothing. So some low-income asset building demonstration programs are underway, and some more than demonstrations. And what they've shown is that low-income families can save. Most of them focus on longer-term savings for, such as individual development accounts generally do, for a home, for education, or for a business, not saving for a rainy day. And these matched savings programs may be an important way to bring some of the asset subsidies so that they reach lower and middle income families as well, not just the higher income families. So while these accounts can be important for the long-term development and well-being, the findings in this brief suggest that providing incentives for low and middle income families to save for a rainy day in a less restricted account is also important. And individual development accounts may be one way to do that. They could be changed to allow for rainy day savings. Thank you. Danny?
Great. Well, I'm really pleased to be participating in this panel and honored to have the opportunity to speak with you all today. I'm going to focus my remarks on some work that I've done recently with Peter Tufano, who's long been of Harvard Business School, but is on his way, I think, literally today, to Oxford to serve as dean of their business school, and with Anna Maria Lusardi, who has been at Dartmouth but is now at GW. This work, titled Financially Fragile Households, Evidence and Implications, is actually going to be coming out soon in the latest issue of the Brookings Papers on Economic Activity, but I'll present a short summary of it here as it relates to the topic of emergency savings. So this work that I'll talk about draws from a sort of novel survey that we fielded in the summer of 2009 in cooperation with TNS Research. And this survey was fielded to more than 9,000 adults in 8 North American and European countries who were asked about the state of their financial house during this period in the midst of the financial crisis. And just for the sake of brevity today, I'm going to focus on the United States. And I'm also going to focus on 2 questions that I think are particularly relevant to our topic today. First, we sought a broad, subjective measure of households' financial fragility. We asked respondents, how confident are you that you could come up with the equivalent of US $2,000, depending on country, if an unexpected need arose within the next month? So here, as Michael talked about income shocks and expense shocks, we really were referring to the kind of expense shock that a household might experience in a major car repair, home repair, or medical bill. And we asked respondents to reply that they felt they could certainly come up with the funds, probably come up with the funds, probably not come up with the funds, or certainly not come up with the funds. We were then curious, though, how would households come up with such funds in the event of an emergency of this kind? And so we went on to ask respondents who thought they might have a chance of coming up with those funds, just how they'd do so. And here we presented respondents with a broad menu of possible coping methods, not just limited to emergency savings, but rather encompassing network support from friends or family, sources of mainstream credit, sources of alternative credit, increasing work effort, selling possessions, really most things we could think of how a family might cope with emergency. And clearly some things are not on this list, we've realized, like deferring payment on bills. We think it's a fairly comprehensive set of ways in which families might cope with emergency. And further, we allowed respondents to pick up to 3 methods by which they might cope with emergency, recognizing that households might bundle together their emergency response from various different sources. So I want to make 3 points from this data, again, focusing on the US. The first is that households really lack confidence in their capacity to cope with an expense shock of this kind. Household financial fragility by this measure is remarkably high, with nearly 30% of families, the far your right bar, reporting that they are certain they could not come up with these funds, and an additional 22% saying they probably couldn't come up with these funds. Nearly half of Americans, by this admittedly subjective measure, felt financially fragile during this recent and ongoing economic crisis. The second point I want to make, along these lines, what we see is that capacity to cope with emergency, or confidence and ability to cope with an emergency, is strongly linked to socioeconomic status. What we see here are the relationships between income, wealth, education, and changes in wealth, and perceived capacity to cope with emergency. And what we see are these very clear continuum and gradients, with those with higher incomes more confident in their ability to cope, those with more wealth more confident, those with more education more confident, and those who have experienced losses in wealth during the economic crisis much less confident in their capacity to cope. We also did some work looking at financial literacy and financial education capacity to cope, and I can talk about that in the Q&A if it comes up. The second point I want to make is that while savings is a very important way in which these households would cope with an emergency, with almost 60% of respondents reporting that they would use personal savings to cope with an emergency, it's by no means the only way in which households would deal with a shock of this kind. We see that nearly a third of respondents would draw on help from family or friends, and this is dominated by family. That 30% might use sources of mainstream credit, such as credit cards. 20% would increase work effort. And smaller shares might sell possessions or use sources of alternative financial credit, although that's still 1 in 10 respondents using providers such as payday lenders or pawnbrokers. And so what we see is high levels of financial fragility and a diversity of methods of coping with an emergency. But the third point I want to make is that while respondents use multiple means of coping, savings really stands out as a particularly important means. And I think this is evidenced by 3 things. First, the largest share of respondents report that savings would be the way in which they would cope. Second, the use of one coping strategy, as opposed to bundling together 2 or 3, is associated with being much more confident in one's ability to cope. And the overwhelming majority, more than 2/3 of respondents who name just one coping method, name savings. Almost no one reports being able to cope just by relying on family or friends, or just by relying on mainstream credit, or just by relying on alternative credit. And finally, third, using savings as a means of coping is associated with advantage. These are higher income respondents, more educated respondents, more financially literate respondents. And so in this way, while respondents use a diversity of means of coping, savings perhaps stands out as maybe more reliable and more valuable than these other methods of coping. So I'll leave it there. Thanks.
I want to thank all of our panelists, but they're not done yet. They're going to continue to share their insights with us. And I've heard many of these talks before, and I've learned a lot, so I hope you've gained some insights as well. So what we're going to do for about the next half an hour or so is engage in some Q&A, panel discussion together. We also want to get some questions from you all. But as I listened, there were a few questions that I started to think about, and maybe I'll start our panel off with some interaction here, and then we'll sort of intersperse with the audience as well. We talked a lot about diagnosing the problem, and that was sort of, if you got the metaphor of today's session, we sort of talked about the repairs in the road and potholes in the road, and today was more the pothole. This session was more about the potholes, what are there. Can you talk at all about why? Why is it that a half of families don't have these these assets available to them? What is it that's holding people back? I mean, we can imagine that some of this is just people fail to expect the unexpected, so that might be one possibility. It could be that I'd rather spend money today on stuff than put it in the bank, and so that may be just a behavioral choice I have, maybe some personal stuff. One could imagine it's about what's available to me. If I'm in a neighborhood where there are no banks to have a bank account, I might not have a bank account. So there might be some supply or accessibility issues. And then finally, it might be some policy issues. You know, for if you, I'm sure May could talk about this, there's probably clients she's had who are afraid to have assets because they could get garnished or because it could kick them out of Medicare or Medicaid, something like that. So could you talk just a little bit about what do we need to know more about? Is it behavior? Is it policy? Is it institution? You know, if you really had, if you could pull a lever, a magic lever, and expand our knowledge in one of these areas, what would you want us to look at?
I'd be happy to start. I think all of them are important. The market failures, the policy levers. But I think given that we're on Capitol Hill today, maybe start by thinking about some of the policy ones. And that a little bit when I spoke, I talked about low and moderate income families don't have the same incentives to save as higher income families. So let's fix that. But at the same time, let's also think about the disincentives that they have to save, which Michael just alluded to. And that is that means-tested assistance programs like TANF, cash welfare, food stamps, Medicaid, that these have restrictive asset tests, many of them. And that the current asset policies are often confusing for the applicants, also for the caseworkers who are trying to help them. And that could not only limit the effect of liberalizing them, there's mixed evidence on whether easing these asset limits increases asset holding, although there's much better evidence on whether putting on an asset test indeed lowers asset holdings than it does. But at least at a minimum, let's make these policies more consistent across programs, more consistent across states, so that people know what the policy is and aren't afraid to hold assets. I know Rourke O'Brien did some work, qualitative interviews with recipients, and all that they knew was that before you apply for welfare, you better close your bank account. And so changing a policy from $1,000 or from $2,000 to $3,000, or from your vehicle equity from $1,500 to $7,500, as Minnesota did, might not affect asset holdings that much right now because people don't really know that it was $1,500 to begin with, and now it's $7,500. So I think it's one minimum would be to stop some of the confusion there. And the recent Farm Bill was a step in the right direction that I think helped with that, but I think that there's a lot more that can be done there.
Okay. Thanks. Well, I mean, I think our research points to a couple possible levers, but it's very much, I think, an open question coming out of our work, at least. And so in some ways, this is a clear case of insufficiency. I mean, we really do see these strong relationships with lower income, lower wealth, less capacity to cope. On the other hand, we see sort of more intangible aspects like financial literacy and financial knowledge being important predictors of capacity to cope with an emergency. So we see that having some financial education in high school does significantly increase the chance that you will be able to cope with an emergency now, when given this hypothetical. On the other hand, so it's not the case that financial literacy explains away the disadvantage of socioeconomic status, and nor is it the case that socioeconomic status is all that explains the financial education hit. Rather, these two things seem to both operate. And it's not clear that we'd want to, give total priority to financial literacy here when these other things are clearly mattering as well. So let me put that out there.
So I want May to answer too, but I also think we should think about to what extent is this just about knowledge? I mean, is it that people, how much of this problem can we cure just by knowing more? And May, you may have some insights on this from your work with your clients. Is it that they don't know any better, or is this really a bigger issue than just what they know?
We absolutely spend our day-to-day helping impart knowledge. We definitely spend an enormous amount of resources on a yearly basis helping people become more financially secure, and that starts with giving them the tools to be able to make better decisions. And this is also in part a market issue, and we know that by the amount of lawsuits that we represent our customers with, and the advocacy that we do with the credit card companies and the companies that offer debt settlement plans. But at the end of the day, despite that mission, we don't believe that poor people are going to budget themselves out of poverty. That what we do is, I think, has a lot of really fantastic accomplishments, and it can be the well from which we draw and the research by which we help inform policy change, but to really impact the 1 in 5 Americans that have income below a basic family budget. I think those are policy and legal solutions.
Great. Let's see if there's questions in the audience. Otherwise, I'll just keep going. So, we do have a microphone. So, is there a question up front?
Hi, I'm Sarah Johnson with the Baltimore Cash Campaign. I just was curious to hear any remarks you might have about the Consumer Financial Protection Bureau and what role they may play in advocating for some policy change for clients that we care about.
Anyone? We can defer that to the next panel. Yeah.
No. I mean, I think that that the Consumer Financial Protection Bureau was a huge political accomplishment and policy accomplishment. So just the fact that this bureau is now exists or is being created, I think is huge, and will hopefully level the playing field a little bit. I think that low-income people who are more likely to take out subprime loans, that those loans were regulated much less than people in the prime market. And so now maybe there'll be more even regulation. So I think that it's a very positive thing, and wish them a lot of support in their big endeavor.
The one thing I can add, and this is work we haven't released yet, but it's something that Peter Tufano, my co-author, is working on, is we use the same measure of financial fragility in an additional survey. But here we also asked folks how well protected by regulation they felt in the products they used. And Peter asked about a range of products. And what you find, perhaps unsurprisingly, is that those who feel more financially fragile also feel much less well protected and feel much more dissatisfied with their interactions with financial institutions. And so it's not that people are necessarily unaware and will benefit from, regulation that they're not even considering. It appears from this work that Peter's still, as I said, working on, people don't feel well protected, and that is associated with fragility.
So let's imagine a world where, regardless of whether we had a bureau or not, there was no more alternative financial services. So that 10% that I think you showed, Danny, we didn't have pawn shops, payday lenders, even subprime credit cards. Are households better off?
We'll mix it up.
Yes, but probably only in the very short term. I mean, it's only going to be a matter of time before the market responds with an alternate to the alternate. So I don't think that's really possible obviously for a number of different reasons. To kind of piggyback on the last part about the Consumer Protection Bureau, the transparency issue, I think, is pretty big for our customers. And if they had, we often scratch our heads with how could you have possibly agreed to these terms? And it's because they just had no idea what the terms were. And they're purposefully obscure. They're purposefully on the 13th page in 6-point font. It's very difficult to make sound financial decisions when you're presented with the options that our customers are presented with. So one thing I think an enormous mission of the Bureau will hopefully be creating much greater transparency. And so it's maybe not so much about just banning everything, but rather creating a more level playing field.
Other responses?
I just wanted to talk, you asked about prohibiting or what happens
if we don't have those?
What if we don't have those? And I think that's a huge question, and there has been a fair amount of research on this. And so it's one that we really need to understand the answer to, because some of the price caps we've seen in some research that we've done lowers the amount of supply that's available. So whether you put low price caps on, which effectively prohibits, or some states are prohibiting, let's understand what happens to consumers when they don't have access. And research has yet to answer whether consumers on net benefit from or are harmed by alternative to financial sector products, even for the most studied product, which is payday lending. John Caskey just did a summary paper that said the big question: are people better or worse off? And what's happening in the empirical research is that people are finding things both ways. Jonathan Zinman looked at when Oregon restricted this a little bit, and what he found is that people shift to plausibly inferior substitutes. People are more likely to have overdrafts on their checking account. They're more likely to pay their bills late. So is this preferable? And then Connie Dunham also concluded that that a 36% price cap would make people worse off. But there's Meltzer, on the other hand, finds that increased access to payday loans makes it more challenging for families to pay their mortgage and rent. So I'd say empirically, people have looked at this. The answer isn't clear. So, and I think the question then needs to turn to, is it the products themselves that are bad and that are harmful? Is it particular suppliers of the products that are misleading or charging excessive prices and it's not an industry-wide phenomenon? Or are there particular consumers who are harmed by these products? And so who are these products good for? And maybe can we find a way that those consumers then are less attracted because they have some better alternative?
We worked with some clients in a community at one point in time, and we asked about issues of how you make ends meet, and one of the comments we got was, bills is bills. That the bills are going to be there no matter what else happens. Bills is bills, and I often think about that when I think about the predicament that families are in. Are there other questions in the audience here? We have another question up front. The microphone's approximate.
Hi, I'm Genevieve Melford from CFED, and my question actually is for May. I wonder if you could elaborate a little bit more on what you see the need for additional short and medium-term products is, kind of what features and what gaps in people's financial lives that could help fill, and if you have any thoughts about ideally what type of institutions could offer these products. I'd be curious about that if that's something you've thought about.
So there currently exists the opportunity to buy a savings bond from the 1040. We've had enormous success with that, where your average tax refund for our customers constitutes a third of their annual income. So they're absolutely using it for necessities. They're absolutely using it to make ends meet. They're still purchasing long-term savings options. So if there was some way to package that so that it met short-term needs as well, I think that's a huge opportunity. Someone previously mentioned IDAs for not just long-term asset building, the 10, 20-year, 30-year option, but the 6-month, 9-month, 12-month option makes an enormous amount of sense, especially if matched. And I guess suppliers, I'm not sure. That's one of the reasons I think the savings bond works so well is because it is with the IRS. Community-based organizations offering IDAs is a little bit more challenging just in terms of reach, but I would also caution solutions that only take place within the tax code too. Does that help? Okay.
To what extent do you see people using long-term savings products for short-term emergencies? So cashing out a 401k or a 529 planner. I mean, to what extent are people really using products that we might think of as long-term savings for short?
Yeah, it's been an absolutely huge problem in the last 2-3 years. Absolutely, it's it's where financial education I think is absolutely key to help people understand that not only are retirement savings protected in a bankruptcy proceeding, but you can also actually have some short-term savings. You can actually have $500, $1,000, don't quote me, facing a trustee. So it makes absolutely sense that even when you stop paying your credit cards to be able to get ready for and start paying your necessities in the face of a bankruptcy, that you also actually create a very short-term emergency rainy day fund. So it's much more a problem and probably the result of that negative savings rate that we talked about before.
Right. And so I don't know if you all looked at that in your research as well, of other people tapping longer-term savings for short-term needs. Is that a relatively common phenomenon?
So we find that when people say they're going to use savings, a very large majority of those folks are drawing from what we take to be short, sort of fairly liquid accounts, like a savings account or a checking account, or even a money market. But not insubstantial shares of respondents, about 15%, report that they're going to either liquidate or sell longer-term investments, or even liquidate or sell some retirement investments, including those that they might have to pay a penalty on for doing so. And so I think it does speak to the way in which we've focused on long-term savings goals, and that for some people may leave them short on short-term reserves, and they may look to those longer-term savings in times of crisis.
Do you think that focus on long-term savings in the last decade has made this recession in any way worse, or at least worse for certain households?
So I'm going to punt on that. I'm not sure I can. I'm not sure I can speak to that really very well. I don't know if others have more sense of that.
Well, I guess I would think that, I don't know if so much the focus on long-term savings, but I think the lack of focus on savings, whether it be short-term or long-term. I think that brief that I just presented suggests that maybe hardship would have been cut in half, you know, and at this Great Recession, at least in part, if people had 3 months of expenses and enough to keep them at the federal poverty level. So I think that I think it's very right to start focusing on short-term as well as long-term, but just overall the lack of incentives and some of the disincentives that low and even moderate income families receive, I think, is the big headline here.
So we can't necessarily conclude that things are worse, but we do think that things will be better going forward.
Right.
Right. Okay.
Right.
Fair enough. Another question.
Actually, a comment sort of contextually on this last point, and like May, I don't want to be quoted too closely on this, but as I recall, I think it's important to keep in mind that, you know, it's really not much more than 50% of the working public that participates in an employer-sponsored retirement account. And it's a very small slice of people beyond that are sort of purely in the individual market for retirement accounts. So when we think about people tapping retirement for their short-term needs, we're really generally talking about the upper half of the income spectrum. And then the other thing I think that's, and I don't want to advertise too much for any one sort of provider here, but I would single out sort of Fidelity as a very big provider of retirement products, who's been very good about sharing slices of their data publicly. And as I recall, their sort of recent releases on this show that, you know, between 20 and 25% of their account holders have taken out hardship withdrawals against their retirement accounts. And I can say with a good deal of confidence that I'm not embellishing those numbers too much. But it's very important to sort of keep that context in mind. That, you know, that is an option for people. And it's an option that's used frequently for people. But it really is something that's used towards folks on the upper half of the income spectrum. People on the lower half of the income spectrum much less likely to have an employer-sponsored account, and less likely also to have a traditional or Roth IRA or some other product out of the individual market.
That's great. It's a great point. I spend a lot of time with people who research pensions and retirement, and very rarely does this comment come out. It's all thinking about saving for when you turn 65, not thinking about the fact that 1 in 4 of them may not use that money at that time. So.
Yeah, just to add a little bit on that, the Urban Institute did put out a brief last year, 2010, understanding early withdrawals from retirement accounts, and it was exactly this finding that less advantaged individuals are less likely to have. I think about 25% of low-income families, or 23%, have a retirement account. And then about 40% of the early withdrawals from these retirement accounts were linked to adverse or investment events, onset of poor health, job loss, home purchase, and college expenses. So these accounts are being used a little bit in that way, of course, which concerns the retirement people, because then that money's not there for retirement. So we're saying, oh, good, a way to tap right now, but then, you know, there's concerns on the other end of that, too.
Bills is bills. Yeah. There's a question in the back.
Hello, I'm Lori Strauss with the ARP Foundation, and how timely that we just talked about retirement, because it relates to my question to you. We at the ARP Foundation are focusing on hardworking families who are 50 and older. And I say that because most people think of us as only talking about retired people, people who are out of the workforce. So my question to you is, what do we know, especially that's new or different about 50-plus workers in the topics that you've talked about today?
to that a little
On
bit.
the ground or in the research, yeah.
So we definitely looked at age as an important attribute in some of the work we were doing, because we very much expected that older workers would have more financial reserves, because we were expecting that people would be saving for retirement. So even if they were taking money out of these retirement-specific accounts, they might have the money available. And this is true. Older workers, those 55, we have 55 and older as our age cut, are more likely to be confident in their capacity to cope and are more likely to use savings. But very large shares of those who are over 55 still would lack confidence in their capacity to cope with what's basically a relatively small shock of $2,000. And so age, we do see this age gradient. The youngest are least able to cope. Those in middle life are more able, and those 55 and older are most able, but large shares of those even over 55 have trouble coping. So this is not a young person's problem exclusively.
Go ahead.
I was just going to add that, when we've looked at household holdings of across the life cycle and focus a little bit on the older income, that Social Security is the key asset, if you consider that an asset that these people hold, that older people hold. So that I think shoring up Social Security, especially for low-income families, is a critical part of any reform that should be considered in the asset building area.
We have a question in back.
John Tambernino, Congressman McDermott's office. Question for May regarding the financial clinic. It's very impressive. My concern is that an approach that service intensive really might not be scalable. And you're reaching 4,000 families in the New York City area, which there's no doubt hundreds of thousands of families that would have a financial profile such that they would benefit from these services. Say if we're talking about the bottom quintile of the population. So given that it doesn't seem to me feasible that that kind of model could begin to be taken to scale for the population that would benefit from those services, talk about targeting, both the targeting you did to identify families that were receptive to this kind of intervention that would be likely to benefit from it, and the kind of targeting that would allow you to reach at least a significant number of the households that would be likely to benefit, even though, again, unfortunately, it seems to me it would still ultimately be a pretty small minority of the population of consumers.
Absolutely. And nor do I think it necessarily should be scaled. It sort of depends on what you mean by scale, though. I mean, there's a need of perhaps as great as 1 in 5 Americans with income below a basic family budget that our services could probably assist in one way or another. I can't even imagine the cajillions of dollars you'd need to be able to make those kinds of services available. But is there a level of scale that we might be, kind of like a lowercase s scale, where we might be able to accomplish to do the on-the-ground research and lesson learning that we need to be able to inform systemic change? So in our model, we absolutely don't pretend to even really scratch the surface of the need, but what we're trying to do is use this as an opportunity to turn around and be in settings like this to help inform what policy change should actually look like. So you've basically pointed to the difference between our mission versus our vision, and I think it's dead on. But the second part of your question around targeting, I think the very particular type of financial coaching and planning that we're doing with our customers is best for people who can in the first couple of meetings articulate a vision for their own future, where people can't see beyond the immediate Band-Aid and can't see beyond the immediate crisis, despite our encouragement and coaching and hand-holding. Our services are probably not the best for them. That, I think, can happen across a pretty wide spectrum of different kinds of crises. We serve people in domestic violence shelters. We serve people that are homeless. We serve people that are searching for jobs. We serve people who are employed. So it's a pretty, I think, wide spectrum of financial insecurity that we can help address. But if people kind of can't get beyond their own head and their own crises, that's probably, we're not exactly for them.
I don't think that's a visual cue that you needed to stop. So.
Sure. Justin just made a quick request for me to add that the New York City has really been on, I think, the forefront of being able to have a regional response to these kinds of needs, and through Bloomberg's Mayor's Fund and the Department of Consumer Affairs has come up with a financial empowerment center for each borough. So similar to the one-stop system for workforce development, they have been able to place a set of financial coaches in each of the boroughs, and the clinic runs the one actually in Queens. Again, though, not nearly meeting the need. And frequently, and that's where, as I mentioned before, we get a lot of referrals from the 311 system, and those coaches are regularly booked 2 and 3 weeks out.
I just wanted to add a little bit, because I think that was a good question about scale, because a lot of, that is hard. So 2 policies that many people have thought about that could bring incentivized savings to scale. One are children's development or savings account, and the vision here is that every child from birth receives a subsidized account in his or her name, and then there's maybe some matches as people, especially low-income people, save money. So these accounts can provide hands-on literacy, they can provide long-term savings, rainy day savings. They might also be a way to get everybody banked, because if these accounts are universal, then this market failure where doesn't make sense for banks to provide low-income people who are going to have small balances a checking or savings account. Well, if it's universal and it's to scale, all of a sudden now it does make more sense. So I think that is one policy. And another one that New York is testing, I think, is an EITC match, in order to take these incentivized savings and move it beyond just newborns. EITC is a targeted program that reaches many people, and create an incentive for people to take that EITC refund and deposit it into a savings bond or a longer-term savings account, but not, also access for a rainy day, and then match that. So it does it through the tax code, I think, which isn't ideal, but it's one way to get these incentivized savings to scale.
Can I add a third policy? And this this comes out of our research to some degree, but also a bunch of other work that Peter and his colleagues have done and that I've worked on too. We find in our study that those who have gambled in the last year are much less likely to be able to cope with emergency, and much more likely to report planning to use alternative or mainstream credit when faced with an emergency. And rather than sort of dismiss those folks, I think there may be an opportunity to leverage that kind of logic, and this is what have been called prize-linked savings accounts. And these are accounts that have rolled out around the world. Half of UK residents own prize-linked savings bonds, and what these do is they substitute the potential to win a very large amount of money for keeping money in your savings account for the very small amount of interest that you will earn on your savings. So for every dollar you have saved, you have one drawing in a monthly drawing to win perhaps $1 million. And that $1 million comes from all the pooled interest that's not paid out to small dollar account holders. If the drawing happens and you don't win, you keep your dollar and you get to enter it again next month. This is an incentive for people to keep money in their account. It is not designed for everyone to get $1 million by winning this prize, but nor are they giving up all that much in the small amount of interest that they would earn on these, $100, $200, $300 in the account. It leverages an existing behavioral logic that is extremely powerful to people, the logic of sweepstakes and prizes and lotteries. And it's been rolled out to great success around the world, and I know that many credit unions are trying to pilot it here in the U.S., and that, to some degree, regulatory changes may help to facilitate it. So I'd put that out on the table as well.
One impediment is that they're basically illegal in most states, right?
That's the main impediment, Michael, yes.
Other than that, we're in Washington, so we can say, we can change. All right, so we're almost out of time, but so many of these questions and comments have come back to this issue of knowledge and information. We know there's lots of ways that people get knowledge and information. They get it from peers, they get it from the coaches, they get it from TV, they get it from lots of different places. How do we impart knowledge about the need to save, the reality that you may face a shock of some kind, how to find liquidity, how to use appropriately what may be even high-cost credit? How do we think about this issue of getting information out, getting advice out? How does the market do that, and how does public policy do that? I'll end with an easy question.
I mean, I think one thing we're seeing that has some potential is to, again, instead of trying to move people to different ways of doing things that they already do, we can leverage the things people do to educate them. And so we see some success in using video games to impart financial knowledge. So people are playing video games, I think, I saw a bunch of you playing Angry Birds on your phones before we got started. But what if you were instead playing Celebrity Calamity, the game introduced by D2D, where you help to manage a celebrity's account, making sure to pay off credit card bills on time and avoid penalties, making sure not to go into overdraft. So perhaps there are novel ways of leveraging what people already do to increase financial knowledge.
I'm just going to add that I would say maybe don't provide financial knowledge alone, but bundle it with access. And so that can be done through the children's savings accounts. It could be, I don't know if, but bundling it with a product at the same time as people are getting access and knowledge. Maybe when you're well-timed, when you're buying that home, that's when you want the knowledge on how to buy a house. Maybe not in high school before, when you're not really thinking about it. You're not going to retain it all. So I think bundling.
My response was going to be very similar, that there are very key transition points in people's lives that I think could be seized upon to help people make the right choices, moving from welfare to work, even increases in your income, being able to save significant portions of that once you've already established a budget, that there are key transition points in people's lives that could accompany products and services that would help almost kind of codify good decisions.
Great. So let me quickly try to summarize what I think I heard here from our panel, and I apologize because I know there are more questions that you all wanted to have. We're going to have another panel, so there'll be more time to talk, and hopefully at some of our break time as well. So I think we heard a bit about the product side, about maybe new, novel, currently illegal products that could be made legal. But that's not just, the birth accounts at birth. There are some new innovations on the product side. We didn't talk a whole lot about some of the barriers. Financial institutions face real barriers trying to serve low balance accounts, and we'll hear about that probably more. But there probably are some innovations on the product side that could be out there, and I think that's something important to explore. We talked quite a bit about policy, and this tension right now about how much regulation, too much regulation, innovation versus having too much, not too much innovation, but essentially too little control over what kinds of products are out there. And then a lot about understanding. Do people understand the products, the terms of the products? Do they understand the information that's out there? And where do they get that information? And you saw in some of Danny's slides about the importance of, I think it was number 2 on your list, was friends. So the places I get money from are friends and family, and these sort of social networks, which oftentimes we don't think a whole lot about when we think about economic models of households. And so these are going to be important as well. I think the main point here that you've heard is that short-term liquidity really matters, and whether you call that, whether it's stored in a long-term account or a short-term account, people need to find liquidity to make ends meet. And currently, it's a problem for a good share, half at least, in at least some of these data, of people to find that form of liquidity for a relatively small amount of money, $2,000 emergency, which probably most of you have faced that sort of size of emergency in the past. Certainly, the potholes that families have faced over the last 4 or 5 years have been significant, and some of them are still in those potholes. We're going to talk more in the next panel about how we start to fill in those potholes, but we also have to worry about getting those families out of those potholes before we start filling them in. So it's a complex problem. We are very much, it's the horribly overused metaphor of flying the plane and building it at the same time, but it's very much what we face with households today. And the stakes for vulnerable households, as you can see, are quite high. With these hardship measures, we're actually talking about the well-being of families, of kids. And it may not seem like $2,000 matters, but it does. And these asset poverty measures, which, by the way, asset poverty measures are not something that's widely discussed out there among people who study households. So it's an important issue. You're talking to some of the folks here who are at the very forefront of a very important issue. So hopefully you've gotten some insights from this. I have, and I thank you all for your participation. And I want to welcome the next panel up.
So it's a different audience.
Nice to see you.
How have you been?
Glad you're here. I leave on vacation. My 7-year-old daughter and my wife tomorrow. I'll let you know That's generally actually it's not included. At sea level, that's kind of essential for ours.
Yeah. You know, they make them for grown-ups.
Yes. Earplugs as well?
Yes.
I think we're good. Just
I am doing very well. How about you?
I'm good. Since we met about 4 years ago when I was doing a little consulting work for you.
Did we agree you would go last or second?
I'm not sure that we agree.
I don't know that we
disagree.
All right. Yes, absolutely. All right.
Mark, and I remember sitting there with you guys. And I went to work about 2 years ago. I went to work at the FDIC for Sheila Bear.
Very nice.
Yeah, and I've been working on these issues, so it's, yeah, it's nice to see you.
It's good to see you.
I'm very interested in what you're going to have to say because we're going through a transition now, as you know.
Oh, yes.
And I think at the end of the day, maybe we should be, I'm trying to figure out what's its evolution and what we should be focusing on, and I think we should be doing very nice.
Oh, yeah.
And we should maybe you'll come over one day and talk with us.
Yeah, that'd be fun.
Let me give you a card.
Okay, yeah, here.
I'm kind of anticipating I'm going to stay there in the Seaport.
It's a good location.
It is.
I also have a bookings email address and a couple of others, so
Okay, great.
whichever you choose to use.
Whatever works.
They all go to the
Is this
same
best
mailbox.
one?
Yeah, they all go to the same mailbox.
Okay.
Oh my goodness, we're being filmed. I can't deny anything.
Webcast.
Ah, yes.
And there are a bunch of our FDIC staff here, so.
Oh, good.
Bring the Hi, nice to see you. How you doing?
I've been given the 30-second warning. This is working. Oh, there we are. Okay, 30-second warning, 15 now, actually. If everybody can take your seats, please. I know there's a lot of great people you need to talk to. I want to do the same. Okay, folks, we're going to get started. All right. All right, good morning, everyone. My name is Ray Boshara. I'm a senior advisor at the Federal Reserve Bank of St. Louis, and I'm also a senior fellow at the New America Foundation, where I worked for almost 10 years. I need to say that my thoughts here today are my own views, and not necessarily the views of the Federal Reserve Bank or its affiliates. So I think I got that down. I've only been on the job for about 2 months now. So anyway, it's great to be here. And I was asked by Pam and Justin to frame and moderate the second panel, Rebuilding the Road to Financial Security. But, you know, Michael's ending provided the perfect segue for the first thing I want to say, which is about the importance of emergency savings. And I have to say, you know, I've been in the asset building field for about 20 years now. Even before Michael Sherradin's book was published, we were working on this idea. And, you know, we started off in kind of a patronizing way, saying we know what the poor need. They need long-term assets. And the whole field was built up around this idea of saving for long-term assets. And we felt pretty good about that. And, but then the data came in, and we found out that 64% of the participants, some 2,300 participants, took an unmatched withdrawal. They forfeited a 2-to-1 match just to get access to their savings. And people thought, well, this is a failure. Well, no, it wasn't. It just turns out that low-income people had multiple savings needs, not just for long-term assets. And that one product simply could not serve all of their savings needs. And so this turned out to be a really important finding. And here we are now, I'd say, you know, 5-10 years later, with emergency savings probably being one of the most important developments in the field, that the need for that kind of savings is critical. And it's critical not only for reducing the need to go to a payday lender, it's also important for getting access to mainstream financial services, and also the source of funds for kind of a longer-term deposit. So it's kind of a sweet spot, and I think that idea, probably more than any other idea, is bringing together all different dimensions of the field around something I think we all agree is very important. So I really congratulate my colleagues for pulling this, I think, incredibly timely and important panel together, and this particular focus on emergency savings. So the little bit of framing I want to do is around kind of a larger idea of, you know, why household financial stability matters. You know, why it matters not just for families, but for the broader economy as well. And I think, you know, where this research is going is that we're finding out, you know, that the health of low-income communities really matters for the health of the broader economy. And that's because you know, at the root of the economic crisis is of course, debt, over-leveraged Americans, which also means that the key to the recovery is going to be deleveraging, families rebuilding their savings and their assets. And it's really, the numbers are really remarkable, if you'll bear with me for a minute. And the way economists measure this is that they look at your loan payments as a percentage of your disposable income. Well, get this, in the 1970s, that was 65%. Shot up to 70% in the 80s, 85% in the 90s, got to 127% by 2008. So if you look at the numbers, we've essentially doubled our level of debt obligations relative to our income in about a generation. It's remarkable how over-leveraged we are. And you know, it's come down a little bit. I think it's at about 116% right now, but most economists agree that we need to get closer to the 1990s average of about 85%. So we've got a long way to go, and it's a huge challenge, this deleveraging challenge. But again, it's really the critical issue, and I think a lot of economists are starting to realize that, you know, it's not just the macroeconomic issues. We really got to start looking at the household. Wall Street Journal, some of you saw the lead story on Monday saying that, you know, household debt is the #1 issue facing the economy. Ben Bernanke last week at the press conference, you know, said that, you know, perhaps the headwind of over-leveraged household, the balance sheet issues are much stronger than we thought they would be. So I think you know, this deleveraging challenge is really critical to not just helping families move forward, but helping the broader economy move forward as well. And, and I think as financial insecurity moves its way up the income ladder, which it clearly is, we're talking about more and more balance sheets having an impact on the broader economy. So, and it's really interesting. Ben Bernanke has also talked about this idea of balance sheets as financial accelerators. When balance sheets are healthy, they actually accelerate the economy. There's more economic activity, more consumption, more saving, and more investing. But when they're, of course, unhealthy, like they are right now, they decelerate the economy. And as a matter of fact, a recent paper by Case, Quigley, and Schiller on wealth effects, which is the concept that connects economic activity at the household level to the broader economy, found two interesting things. One is that, that household wealth effects are potentially much more significant than financial wealth effects. Your stocks and investments, people generally assume, economists assume that the stock effects are greater, but it turns out that the housing effects are probably greater. But the other very interesting finding is that it's asymmetrical, and what that means is that when balance sheets are down, it has a greater impact on the economy negatively than if they're up and having a positive effect on the economy. So it matters more when we're in a downturn in terms of how household balance sheets affect the broader economy. So this is a way of all saying that the balance sheet issues that we're all looking at here today and the policy issues, I think, are particularly important. It's hard to imagine any kind of a solution without, first, broader economic growth. If we try to do deleveraging absent income growth, it's going to be very harmful to the economy. But secondly, it's also hard for me to imagine any kind of a solution that doesn't involve public policy. It's very important. So families just can't do it on their own. It's kind of what May said. You can't expect families to budget their way out of poverty. I was really struck by that comment, but I don't think you can expect families to deleverage all on their own as well. It's just the challenges are simply too significant. So along those lines, I just wanted to mention briefly that I'm pleased to report that the St. Louis Federal Reserve will be starting some significant work on household balance sheet issues, on the deleveraging challenge, and their connections to the broader economy. We're just getting this work started. We see it as complementing and leveraging the great work that's going on in the room already, and I look forward to working with many of you on that front. So stay tuned, please, for that. So today's panel could not, of course, be more timely and more important. And, we have an incredibly impressive panel here today, almost a dream panel for the issues that we're going to talk about. And I really say this with all sincerity. Every one of the folks up here is among the best, if not the best, in their respective fields. So let me just introduce all of you, and then we'll go from there. Ellen Lazaire, of course, is with the FDIC, a senior advisor to the chairman for consumer policy, and she is the lead advisor to Chairman Bear, a real hero to many of us, on all the issues before the FDIC's Committee on Economic Inclusion. Many of you know Ellen has held several really impressive leadership posts throughout Washington, and I've been a huge fan of her work for many years and have learned a lot from her. We're very fortunate to have her. To her right is David John, who's a senior research fellow at the Heritage Foundation, and I came to know David probably a decade ago at least, probably longer, for his fabulous work on retirement savings, which has evolved into work on auto IRAs and other things. And he's done a lot of great work on retirement security, but he's also worked on the other end of life, on child accounts. David worked with me to secure Senators Santorum and DeMint to join Senators Corzine and Schumer on a child saving account proposal called the Aspire Act. Back in the days of bipartisanship, 4 or 5 years ago, when we were able to do things like that. And, David's work truly spans the life cycle, and we're fortunate to have him here today to talk about non-retirement savings today. And Lauren Sanders is the managing attorney for the National Consumer Law Center and handles legislative, administrative, and other advocacy efforts on behalf of low-income consumers. And I didn't get to know Lauren personally until very recently. But she clearly is a mover and shaker in this area, and I've admired her work from afar and read her reports, and it's great to have her on the panel today with us. So I will stop here and turn it over to Ellen, and then we'll take questions after that, after we go through the panel. Thank you.
Hello, everybody. Good to see you all here today. I'd like to thank the New America Foundation and the Center for Financial Security at the University of Wisconsin for inviting me here today. It's particularly nice to be here with both Michael and Ray, who I've worked with over the years. I thought it might be good for a minute to remind all of you about the mission of the FDIC, since we've been in the paper so much lately, and I'm not sure that everybody always knows what we're supposed to be doing. The FDIC is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system through insuring deposits, examining and supervising financial institutions for safety and soundness and compliance with consumer protection issues, and managing the receiverships created when we close banks. In addressing our mission-related responsibilities, we promote sound public policies and address risks in the nation's financial system. To further these efforts, let me move this along. Uh-oh. Help. The arrows. Okay. Thanks. To further these efforts, we've recently established a new division of depositor and consumer protection, moving our compliance, exam, and enforcement responsibilities to this new division and enhancing our policy and research efforts to not only comply with Dodd-Frank, but to coordinate with the new Consumer Financial Protection Bureau as well. Chairman Baer, early in her tenure, made consumer protection a key focus of her work and established an advisory committee on economic inclusion, which includes many academics, advocates, bankers, and lots of people that you all know, to help, to provide us basically with advice and recommendations to expand access to banking services for underserved consumers. We believe that a strong mainstream banking system, one that inspires confidence and treats people fairly, should be accessible to all Americans, giving them the opportunity for transparent, well-priced products, the chance to build credit and save. I'd like to talk with you today about our research and our FDIC small dollar loan and model safe accounts pilots, which we hope will inform financial institutions and bring more people into the economic mainstream. Some of you are very familiar with the survey that we did with the U.S. Census in 2009. It's a survey of unbanked and underbanked households. We learned quite a lot from that survey work, and it really has continued to inform our work going forward. Among the findings were that 7.7% of all U.S. households are unbanked and 17.9% are underbanked. 17 million adults don't have a checking or savings account. 43 million adults do have an account but also rely on non-bank financial products to make ends meet. Some of you know that I spent a lot of my time over the years in the community development world and worked very hard over the course of 25 years to help rebuild neighborhoods just to see them proliferated by check cashers, payday lenders, and others. So this has become a very personal mission for me. Most of these folks are more likely to be minority or lower income consumers. Of the unbanked or underbanked, 54% of black households, 44% of American Indian and Alaskan households, and 43% of Hispanic households are unbanked or underbanked, and 70% of low-income households are unbanked or underbanked. Clearly, this has a real impact on our communities, and the services themselves can be the alternative financial services can be very expensive and very harmful. We decided to see what we could do about inspiring financial institutions to provide products that were more competitive, were fair, more transparent, rather than having to go to payday lenders, use check cashers, or pay very expensive fees for a series of other alternative financial services. To that end, we set up a small dollar loan pilot in 2007, which was basically designed to illustrate how banks can profitably offer some alternatives. The small dollar loan pilot encouraged more banks to offer small dollar loans as an alternative to payday loans, overdraft, and other high-cost short-term emergency credit options. The loans were based on some guidelines that we published in 2007. We were looking at loans of $1,000 or less, payment periods longer than a single paycheck, interest rates below 36%, low or no origination fees, streamlined underwriting and quick processing, and optional features like automatic savings and access to financial education. The key to this, after we published guidelines and solicited participants in the pilot, was to encourage institutions to innovate and experiment. This is really where some of the more valuable lessons came from. We concluded the pilot with 28 banks ranging in size from 28 million to 10 billion and operating in 27 states. We had started out with about 31 banks and had a few dropouts along the way over the course of 2 years. The banks made more than 34,000 loans with a principal balance of roughly $40 million. The lessons learned were interesting. One thing we found was that the defaults on these small dollar loans in our pilot were in line with the default rates of similar types of unsecured credit. So we felt good about that. We also found that $1,000 didn't quite work. We started the pilot measuring small dollar loans of $1,000 or less. We really found that the banks themselves needed to expand those and make slightly larger loans of up to $2,500, which provided more revenue ultimately for the banks. We tracked both the small dollar loans and what we came to call nearly small dollar loans. In addition, we found that we needed longer terms for those loans. Clearly, payday lending keeps people on a treadmill, and what we found was, in order to have better performance and for people to have more time to recover from financial emergencies, we needed to make the dates, the repayment dates longer. So we went from an initial average of about 90 days to, as the bare minimum, to averages of 10 to 16 months. We recommended streamlined but very solid underwriting. It was really critical for mitigating defaults. Most of the banks ran a credit report mostly to determine how much the consumer could afford and to weed out fraud and bankruptcy, and we asked for proof of identity, address, and income. The turnaround times, which is key to competing with the payday lenders and others, was not too bad. It was within 24 hours, and some we found were able to do this in less than an hour. We also linked savings and financial education to these loans to test whether they would improve loan performance and help build savings to reduce future high-cost borrowing. It worked out pretty well when they, in fact, provided financial education or linked savings. Some of the institutions really felt it was necessary to kind of break the cycle of high-cost lending. Others believed that complicating the process would drive consumers to payday loans, so we gave people flexibility with that. The big lessons learned for us was that the driver for a lot of these banks was that the long-term relationship building was primary. Banks were able to generate longer-term profitability through volume and cross-selling. We also, a few banks did achieve some short-term profitability, and it's interesting for those, we're all concerned with low-income families here, and the short-term, the most profitable these loans were in census tracts with high concentrations of LMI or immigrant households. I should also mention that these loans were important for some of the institutions for CRA purposes and also for solely for community goodwill. They tried to, many of them were trying to be responsive to the needs in their community as well as being responsive to us. And there seemed to be a real push towards thinking about ways they could use this for their CRA credit. Other program elements that were linked to the success of the program were strong senior management and board support, an engaged and empowered champion within the institution, and proximity to large populations of consumers with demand for small dollar loans. And there was limited competition in some rural markets. What we came away from this 2-year experiment with was a template that we've broadly distributed. It's on our website, and it really is a guide for financial institutions who want to do this work. We also wrote a longer article with case studies, and you could find that all at our www.economicinclusion.gov website. I'd like to take a minute or two to talk about our FDIC model safe accounts pilot. This time around, rather than doing the template at the end of the pilot, we did the template at the beginning of the pilot. You know, for us, we wanted to determine the feasibility of insured institutions offering safe, low-cost transactional and savings accounts that are responsive to the needs of underserved consumers. We did this by developing the template, which I'm going to show you a little bit down the road. But basically, we launched the pilot. It's a 1-year pilot to test the efficacy of these accounts for 1 year. We just received our first quarter worth of data, so it's too early to really report anything. But Sherry Ryan, who leads the project, Sherry, is here in the audience, and we could talk about it a little bit with her in a few minutes. The template that we develop's guiding principles are transparent rates and fees that are reasonable and proportional to costs, access to the benefits of the mainstream banking system, FDIC insurance, and the benefit of federal consumer protection laws. Some of the features on the template, which you can see here, are what we developed was a card-based electronic account. We wanted to reduce the acquisition and maintenance costs for banks and remove product features that consumers have had trouble with in the past, like checks and overdraft. The line in the sand for us, as we evaluated the 63 potential participants in this pilot, was that we were not going to permit anybody who was offering overdraft or NSF fees. So we made a line. We removed barriers to entry. We wanted to make sure that there were low opening and minimum balance requirements and low or no maintenance fees, and ability for consumers to meet all their banking needs within the mainstream banking system. Online and mobile banking and bill pay, direct deposit, 2 free money orders or e-checks, and automatic savings. The template here doesn't show, but we suggested auxiliary features could include financial education, linked savings accounts, small dollar loans, or lines of credit. As you can see, we have a nice wide-ranging group of participating institutions. At the end of the day, we ended up with community banks, and it wasn't what we were actually seeking. We had hoped that we would get more larger banks participating, but we really came up against a time limit on their ability to move their IT operations to accommodate these accounts. The first 7 banks are community banks offering both transactional and savings accounts. We had geographic and market diversity and various asset sizes. Citibank and ING are participating in the savings portion of the pilot. Citibank is piloting these accounts in New York, and ING is piloting them in 4 markets around the country. Again, Chairman Baer likes to say that in 77 years, no depositor in an FDIC-insured institution has ever lost 1 penny. Our hope is to help financial institutions that we regulate be inspired to better serve the unbanked and the underbanked, and that's what we're doing. Thanks.
That's perfect. Thank you. One of my weaknesses is that I'm a bit of a Luddite, so I don't use PowerPoint unless absolutely forced to at gunpoint. And these people were kind enough not to. First off, thank you to both the caucus, the Center for Financial Security, and New America for allowing me to speak to you today. We all know we need to save, and this is true among all income levels and up and down every spectrum that you can come up with in the U.S. However, actually doing it is something else. Now, my wife is thoroughly convinced that I need to eat more vegetables for some strange reason. After nearly 11 years of marriage, she's finally realized that certain things are going to happen sooner than others. In this category, hell freezing over. But if we carry this over to the question of savings, financial decisions are harder. All I have to do is look at the broccoli and look off to the side or something along that line. A financial decision, we have learned the hard way, is confusing in many cases, and when people know they have many things at stake, they don't feel that they have adequate information or an appropriate, easy response to this. They take the natural human element and do nothing. And the net result is that despite everyone's best intentions, people don't save. Now, Ellen had some fantastic statistics on the proportion of unbanked population. Realistically speaking, this is a combination of cultural activities or cultural inclinations. It's the fact that in many cases, banks and credit unions don't have branches in low-income neighborhoods. It is due to the simple fact that people know they need to do something, but they don't know what it is. So what we're proposing, and these are proposals as opposed to Ellen's, which are actually pilot projects where she's actually done something, is that we take the 401k IRA retirement savings system and repurpose it to an extent. Now, the immediate response needs to be, as was pointed out in the first panel, well, only about 50% of the workforce has access to this system. And should someone ask that question, I will give you a short, quick ad for something called the automatic IRA, which would expand coverage from 50% of the workforce to about 90% of the workforce. It's something that has bipartisan support, one of those rare things that still do that sort of thing. So what we're talking about is essentially, once again, stealing an idea from the British. I mean, we stole the idea of Parliament and kind of redid it and made it into Congress. And in this case, we're going to take something called the wrap account. And a wrap account is something that is already existing in UK defined contribution savings system, where it also allows the individual to take a certain amount of money and save it for non-retirement purposes. Now, the advantage of this, if we combine it with an American innovation that the British are adopting as of January, automatic enrollment, is that we actually have a delivery system that both is proven to work and that workers love. If you go to a website called Retirement Made Simpler, with an R at the end, simpler, because somebody else had the other domain name first, you will see in the resources section a series of surveys that we did of workers who were auto-enrolled. 85% of them started saving before they would have otherwise. Of those who were auto-enrolled and stayed in one of our surveys, 98% loved the mechanism. Of the relatively few people who opted out, over 80%, nearly 90%, loved the mechanism. So now let's use this mechanism for something else. In addition to the retirement savings, because let's face it, we don't want to have people who are essentially delaying a crisis. In addition, we can add a proportion of savings that would go to non-retirement purposes. From some discussions with people who are actually working on some of the practicalities here, this would probably be a non-ERISA account. So that also will ease the concerns of certain employers. We can take this money, and it could be automatically deducted, and I'm just going to make up a number here because, you know, economists love to do that. If we had individuals saving, say, 5% of their income, 3%, 5%, or whatever, for retirement, we could add another 3%, 4%, or whatever. The individual has complete control over what proportion this is done here that goes into this non-retirement savings. Basically, it could be a bank account. It could be a credit union account. It could be something I'm going to discuss in just a couple moments called an R-bond account. But basically, it enables workers to save at their place of income, or it enables them to do it automatically, easily, and it's there if they need it. The withdrawal could be done electronically. It could be done through a check that's sent to them, or it could be done through a bank account or something along that line. There are lots of different ways that this could all be set up and used. But what we can do is take savings and make it more automatic and make it easier for the very population that needs it, because if we look at the research, and we have a significant amount of it now on automatic enrollment, the people who benefit the most are lower income workers, younger workers, women, members of minority groups, and employees of small business. These are the people who could benefit from this. Now, we could put this money into a bank or a credit union or something along that line. That's a very valid approach. There is another alternative, which is that we take something that we also developed for the automatic IRA called an R-bond. An R-bond is a government bond account. It was initially set up because we had complaints from the financial services industry about the cost of maintaining small sums. We heard earlier in the first panel a discussion about the number of people who put money in a U.S. savings bond by doing it through the 1040 or something along that line. Well, instead of putting it into something like this, we could easily put it into an R-bond account. An R-bond account is not a purchased instrument with a set maturity or something along that line. It is a bundle of retirement or of savings instruments, non-retirement savings instruments here, that would have an interest rate that is higher than the I-bond. It would have no costs to it, administrative costs to it. It would have easy access. The way we have it structured with the automatic IRA is that once it reaches a certain level, $5,000, it would automatically be rolled into the owner's choice of a private institution, but the owner would also have the opportunity to say, no, I want to leave it where it is. This is not a checking account. That's a key factor here, but it is an account that is available for emergencies. 10 years ago, as part of another heritage project having to do with accounts to some government program, Social Security, I think it was, which was stunningly unsuccessful, we talked to the head of the savings bond unit at the time. And the response was, we've got the ability to do this already. Now, that was 10 years ago. So we've got two opportunities here to expand savings into the very community who needs it the most. Thank you.
Well, hello, everybody. I also don't have a PowerPoint. Thank you also to the caucus and the Center for Financial Security and New America for the opportunity to talk to you today. The National Consumer Law Center was originally formed to be a legal services backup center. We were one of the sources of legal expertise supporting the network of poverty law programs around the country, helping people, low-income people with their various legal issues. Obviously, we focused on consumer issues. We continue to play that role. We also provide a lot of legal expertise to policymakers and other advocates working on behalf of low-income consumers. We are so thrilled to be here today and to join this conversation about the road to financial stability. And I was invited to talk about the credit issue. And I think it's very important to remember that the first step on the road to financial stability is to stop digging a bigger pothole. To use the metaphor of the day, and to stabilize your finances. And too many small dollar credit products out there make matters worse rather than better. Products are justified or rationalized for emergency use, but in fact they're designed for more routine and more repetitive use that just make problems worse rather than better. The evils of payday loans are, of course, well documented. Not just their high cost, but their short lump sum balloon repayment structure that encourages a cycle of debt. And a number of institutions are looking at alternatives to payday loans to serve the obvious needs of low-income consumers. But of course, their first need is primarily income and not credit. And credit is not a substitute for income. And we find that a lot of alternative products that style themselves as payday loan alternatives, in fact, have the very same problems of payday loans. A number of them are somewhat cheaper, but a slightly cheaper payday loan can still get you into the same sort of cycle of debt. We're very fearful that banks are getting into the payday loan business. We identified some of the bank payday loan products in our report on stopping the payday loan trap, and more are jumping on this payday loan bandwagon. Another large bank jumped on the bandwagon last month with these account advance products where they will advance you $10 per 100, repaid immediately with your next deposit. Yeah, it's a little cheaper than a payday loan, but it's the same sort of, very short-term lump sum balloon payment structure that traps people in that cycle of debt. Another problem that a lot of the alternatives pose, like payday loans, is they satisfy that need for fast cash. Fast cash is a problem. You should think about whether you can take on debt. Credit, of course, is debt. And we think it's more important for somebody to be more thoughtful and only, seek out credit when, they've really considered that it's the appropriate rather than serving that impulse need. Bank of America, which took the high road on overdraft fees, eliminated them on their debit cards, is considering getting back into them through an option of opting in with your cell phone. The moment your debit card's denied, you can, they'll send you a text message and you can opt in. Those sorts of products we think are dangerous. That fast and easy access credit is dangerous. There was a very interesting article in this month's New Republic by Jamie Holmes of the New America Foundation about why can't more poor people escape poverty. It talked about the social psychology research on depletable self-control. The more that you have to use willpower and make difficult choices, you do it once, and it's harder to do that the next time. And poor people, of course, face difficult choices every day. Things that for us are easy, well, do I want to go out for lunch or not, for them are difficult choices. And we make it harder for them if we make easy credit options something that's an easy temptation to give into. And helping avoid those temptations is more important to help people address their full picture and not just satisfy a short-term urge. So instead of pushing fast cash and payday loan alternative lookalikes, we think a truly affordable small loan is built on the FDIC's template. Of course, first and foremost, at a reasonable cost of 36%, which is, after all, a quite high rate of interest. I mean, we don't have a problem with a single annual fee that doesn't roll over throughout the year to take into account application costs. But beyond the cost, it also needs to be structured in an affordable way, as Ellen described. It needs to be a multiple installment loan product so that each payment, can fit into the person's budget rather than just setting them behind the next pay cycle. So something, 90 days or longer. And another element I would add to that is we think a truly safe alternative small loan is not tied to automatic repayment from the person's income. The credit should never take the very first cut of your income when it comes in before you buy food and pay your rent and pay your medical expenses. And for lenders, relying on that automatic repayment feature leads to sloppy and lazy underwriting. It leads to lending based on the ability to collect rather than lending based on assessment of ability to pay. Now, these sorts of alternative, affordable alternatives are not going to be widely available. They're difficult, but they shouldn't be. I mean, credit is not the primary solution for low-income families struggling, just to make do on the money that they have. And on the policymaking side, we do urge policymakers to take a hard look at how credit products operate in practice. One of the great things of the new Consumer Financial Protection Bureau is that it's going to be very data-driven and research-driven. It has the opportunity to go in there and look at what in fact are the impacts of particular credit products structured in different ways. And I think policymakers need to encourage ones that are structured in a more affordable way. But at the end of the day, we shouldn't be afraid of restricting access to dangerous forms of credit. Because the road to financial stability is really paved more by savings, by budgeting, by income, and not by adding to your debt through more credit. Thank you.
Thank you. Great presentations. Let me begin with a question to all of you. You've either talked about or include in your proposals default options in various consumer products, the savings feature and the small dollar lending program. David, of course, the whole auto IRA and a lot of your work. You talked about not having an automatic savings feature for a loan repayment, Lauren. Just sort of a broad, maybe philosophical question. How far do we go with defaults in consumer finance? What's sort of the right balance between making choices for people and giving them choices and empowering them to make their own choices? How would you draw that line?
It's a hard question, and it's one that we've gone back and forth on a number of different times. For a savings vehicle, there aren't that many different alternatives. Essentially, you go to a bank account, a credit union account, an R-bond account, or something along that line. In general, I think what we've discovered from the retirement world is that you get people on a path, and then as they start to learn, as they start to have more experience, at that point then they have the opportunity and more information to actually move, and the confidence to move to something else.
Interesting. Please.
Well, I think we always make choices when we design a product. And so it's a false dichotomy to say, do we give somebody a choice or not? We make choices in the design of the product. And overdraft, obviously, for many years, the banks made the choice for the consumers that they should have overdraft fees. And they should add a $35 fee every time that cup of coffee went over by 50 cents. And with the Regulation E changes last year, consumers now have to opt into overdraft fees, and the early data is showing it's actually having the impact of account balances rising. There was a report that came out just a couple of weeks ago that showed that. We've heard that anecdotally from some banks. But defaults can't do all the work. Again, with overdraft, we found that a lot of banks, can work hard to overcome the default option and push people and pushing these predatory products on people, calling them up, hounding them. Why haven't you opted in? A friend of mine, just got those calls the other day, and the script from the person was, "Really? Why wouldn't you want to, have $35 overdraft fees?"
I would just say, to add to that we have an opportunity coming up as the CFPB is going to be focusing on these things to really talk about them and better educate consumers. I think at the end of the day, that's the big opportunity that we're going to have.
Interesting. Yeah, just to pick up on your comment, Lauren, I think the financial services industry has long been using behavioral economics against the wealth-building aspirations of low-income families. The question is, how far do we go on behalf of consumers to deploy that as well? And I'm not sure there is an easy answer, but I think it's obviously a question that we have to think about going forward. Great. Okay. Can I see some hands? How many do we have here? What I'm going to do is take the first three and let you each ask a question, and then I'll give the panelists a chance to respond. So just state your name and your affiliation and ask your question, and then after the first three, I'll give the panelists a chance to respond. Please.
My name is Li Yang from Montgomery County, Maryland, and I have experience and I have identified a lot of problems, and property or homeless is not the fault of the homeowners or consumers. And when they complain, there's no way they really have processes through. And so, I also wonder whether the data you collected, whether that's in economic or income or the debt or credit bureau or small business bureau or any, not just consumer agencies, but health agencies or law enforcement. So those are related, and they are really victimized. So our citizens, our consumers, especially, of course, minority, but now they also victimize elderly, whether it's black or white. So I just wonder, if you don't have the data, and how could you design all this, whether that's good or bad? Most likely, it's a bad legislation is easier to pass. Good legislation or good officials is hard, just like Elizabeth Warren. So I just wonder, if you design all this without the proper data or without the supervising all those improper processing or complaint, really investigate into those problems, it's very difficult to have remedies. So I just wonder if we can put some effort on this area.
Thank you. Next question, David, and then I saw one more hand in the first batch. Yes. Okay. Thanks.
David Stace, Policy America. I asked this question having been a longtime fan of CDFI fund program. For those of us who's followed this for a while, what we've seen is the abandonment of traditional financial institutions in low-income communities. And the outfits that have moved into that vacuum have essentially been alternative financial service organizations with mixed results, if I could be charitable about that. But the question is, why didn't CDFIs move into that vacuum?
Thank you. Last question for the first round.
Hi, Debbie Visser from NeighborWorks America. I'm curious if there's been enough activity related to children's savings accounts domestically to be able to show some impact on young people and on family household savings.
Okay, thank you. Please respond as you'd like. Brief responses, and please, go ahead.
Okay, it's an interesting panoply of questions. So I agree that we need to stop blaming the consumer. The subprime crisis is an obvious example of that. Millions and millions of people don't fall into bad loans because they, were bad people. They, the system enticed them in, and the same thing happens in the small loan market. And I am also worried that about financial institutions abandoning low-income consumers. I'm worried that may happen more and more as overdraft fees get squeezed as a source of income. The prepaid card market is developing, but we need to keep an eye on it and to make sure that everybody has access to a safe and secure transaction account.
Okay. Why don't I respond to the CDFI question and the community question?
I think you're pretty well positioned. Anyway, and let me say I'm speaking in my personal capacity and not as a member of the staff at the FDIC. I always felt that it was very hard to set up de novo banks. And as a board member during my hiatus from government service of a de novo bank in Adams Morgan in Washington, D.C., I think it was very hard. President Clinton had run on the idea of setting up 100 community banks when he ran in '92, and that was really the inspiration for the CDFI fund. And I think it's just been hard to set those banks up and sustain them. That said, on the credit side, many of the CDFIs that operate do provide credit to lots of low-income communities around the country. They've been focused on real estate lending, on small business lending, not necessarily on consumer lending. And that's what we're talking about here. And my colleague from the Treasury Department, Louisa Quitman, who was on our team at the CDFI fund, we've discussed this throughout, the need for CDFIs to start thinking more about consumer products, and I think it was, a timely point. Thank you.
Well, I also agree that there is nothing inherently evil in a consumer who finds himself or herself in financial difficulties, especially because that can happen to anyone at any income level at any time, depending on circumstances. I also agree that it's a lot easier to pass bad legislation than good legislation. The problem is coming to a consensus as to which is which in there. Now, the CDFIs were something that I worked on in an earlier job with credit unions, and I love CDFIs and the like, but I think what this proves is that the problem is not going to be solved by some sort of a magic bullet, that you can't just say, here we have a solution and it's going to solve everything. The child accounts, unfortunately, is a similar situation right now. I would love to see a broad test of child accounts, but the only one we've really got is in the UK, and that effectively ended this year. So we can look at some of the data from that, but at this point, we don't have enough to make a firm decision.
I agree with that, but I would add that there is research that it wasn't testing child accounts per se, but a really encouraging body of evidence showing that basically the earlier in life that kids have assets, the better they do, and that there are a fair number of very strong educational, psychological, behavioral outcomes associated with asset ownership, whether it's in the child's name or in the parents. So, the evidence is encouraging, but, and the seed demonstration here in the U.S. was helpful and encouraging, but certainly not large scale. And we certainly hope to leverage the 4 or 5 million accounts they did open in the UK to learn something about that experience. Justin, how much time do we have? Okay, we have time for more questions. And again, I'll take these 3 hands. Again, state your name and affiliation. Thank you.
Hi, I'm Stephen Friedman from MDRC and a researcher on the Save USA study. There are 2 kinds of innovative savings products, maybe more, that have been talked about today, but they work very differently. There is the IDA or a matched savings account model where people deposit one time a fairly large amount of money and then leave it for a year or longer. And then there's the auto save kind of model where little bits get deducted eventually without people even noticing it, so they don't even think of it being deducted. And the other is more like the CD model, where people lock it away for a year and forget about it, hopefully, until it becomes due and they get money. They seem to appeal to different types of people, different psychologies maybe, different abilities to do without, the money right away. And they're all sort of new and don't yet have a big number of people using either. So sort of what are some of the ways you might learn about, which type of product works for which kind of person, of income or psychology or circumstances, since, they're going to have to be choices about scaling up and targeting different groups.
Thank you. Second question, yes, thanks.
Rachel Anderson, Center for Responsible Lending. And I had a question about the FDIC small loan pilot, which is if there's any information about the continuance of those programs after the pilot and uptake from new banks. And just also if you have recommendations for strategies to encourage more banks to participate, either from kind of a policy direction or a community direction.
Thank you. Okay. Yes, right behind.
Hello, my name is Sylvia, and I'm from the community, let's just say. My son, at the age of 3, wanted to open a bank. How did he know there was going to be a recession at this time? He's now 14, I don't know. But looking at that and looking at some of the issues that may have come across in the research in regards to the project, the pilot project that you've had, if an individual wanted to go into the process of not necessarily doing a credit union, but actually going through with the process of opening up a bank, what policy would a person need to look into and seek after to find out what is available, can be done, and how it can be, what way it can be done? And also with your pilot program, what would you recommend at most to begin to start that venue to see people who are on whatever level of income they are, in poverty, as he said, it can be at whatever level, economic level. So what would be your advice or your recommendation for that?
Okay, I think we'll start with Lauren and work our way back and answer which question you'd like, but also use this opportunity to put a final thought on the table if you'd like.
Okay, well, I'm not sure any of the questions were really aimed at me, but I'll just address the issue of the profitability of the small loans, and clearly it's a challenge. I think, if minds are put to it, to a certain extent it can be met, but as long as overdraft fees and more expensive forms of credit are providing a lot of profits, we're just not going to have that attention. And I think small loans need to be viewed primarily from the perspective of relationship building, as Ellen mentioned, and not so much as a profitable product, which is just consistent with my overall theme that credit is dangerous, and for this population in particular, and it should be used sparingly and not routinely.
All right, I'm just going to address the question of choice of products. I mean, we have a variety of systems out there, and frankly, it's going to require a certain amount of testing to see which works with whom best. But at the same time, we do have a fair amount of experience with automatic enrollment, and we do know that automatic enrollment works pretty much across the board, and there's actually indications that lower income workers may be more likely to stick to a default than upper income workers would and actually participate. So while we don't have non-retirement savings tests with that, if anyone would like to fund a study on that, we'd love to talk. But on the other hand, this is something that we have indications that it does work. We can build savings, but we're not going to build savings just by going through and following the same old methods that haven't worked in the past. We're going to have to look at something that's new and somewhat different and see what we can innovate from that.
Okay. Let me try to respond to the two questions about the pilots. To Rachel's question about the continuance of the pilot and strategies for banks to participate, in our Committee on Economic Inclusion work, we've kind of now done, we're in the midst of Small Dollar Loan 2.0, and one of the things we're looking at is employer-based strategies. If you go to our website, there's some information about a number of other types of products that we've seen that we thought were interesting with local government working along with other community players to provide small dollar loan like products. We're also, most of the banks that we're aware of who participated in the program are still offering these accounts. We don't have any hard data, and if that's something that would be useful, it's something that we probably can find out more about and share with you. The second thing is on the savings, what you would look for in opening a bank account. Our Model Safe Account template sets forth a series of elements that we were looking for in savings accounts, which included making them a card-based electronic account, interest-bearing, free direct deposit, free automatic savings, free online and mobile banking bill pay, free electronic statements, and a very small opening balance of $5 and a monthly minimum balance of $5. We'll see how what type of data we come up with when we get the results of the 9 banks who've been participating in this. That all said, you could go to our website and find some of those criteria up there.
All right, thank you. I think if Michael's takeaway from the first panel was emergency savings matters, I think mine would be that institutions matter. And we heard a lot about the tax time institution, and here we heard about financial institutions and employers. And I think the big development here is that we're sort of figuring out how to leverage these institutions on behalf of low-income families. So thank you all very much, and please stick around for Governor Raskin. Thank you.
Pleasure.
Thanks, Ray.
Thank you.
Yeah, was it useful?
Yeah, oh, that's great. Hi, it's good to see you. How are you doing? Oh, congratulations. That's magnificent. I would love to. Thank you. All right. Yes, hi.
I'm Sherry from the FDIC.
Yes.
I heard you before speak about this
Mr. Potholes.
I remember your question.
No, I was told to find you by Sarah. Thanks for coming by. Let me give you my card. I'd like that. Thank you.
You guys doing the thinking stage.
We're starting the thinking stage.
Look forward to seeing you. Thanks a lot.
One of the Arbonne papers. But it's strictly a draft, and it's only for the retirement. Sure. And it's strictly retirement at this point.
An Arbonne, so something that already exists. I just don't know.
It actually doesn't. This is the interesting thing. There was an Arbonne account that was
Let me take a look at my look.
as a fallback when the IRA was developed, and it was never necessary. And it was actually repealed sometime in the mid-'80s or so. And what has happened is that we've gone back and looked at that and restructured it. We've learned from the I-bond and various things along that line. But I'd be happy to discuss it with you.
Well, I'd like to do that.
Here, let me give you.
I appreciate it. Maybe we could grab one of mine.
All right. Yeah, sure.
Thank you, Lauren. Terrific. David, thank you.
Certainly.
It's exciting.
Have a good time with your trip. Where are you going?
We're going to a wedding in Maine, and then we'll be at my folks' place in Vermont.
Oh, that should be fun.
This time of year, I like leaving Washington, D.C. for New
Yeah, you're smart.
That's a wise choice.
I would like to talk to you.
Where are you going?
It does come in here. how these work and what that means in terms of
I grew up in Montpellier, so like it's very fortunate to be able to
options.
Yes, yeah, not very far away. Yeah, Washington's an interesting place. The kids there tuition any school that they want. So, in Montpelier, I chose
So, I like to
life cycle because it choose all the local festivals they pick the one that
I sat there, I've got an MBA in finance, and I sat with my brother-in-law, going through his 401k, and after about an hour and a half of extreme frustration, we decided our best use of our time was to have a beer on the back porch.
I love it. It's great.
Yeah.
I've got a couple of brothers, and they worked for it.
How was your kid?
And they're supposed to make these decisions. I mean, it's like, here's my phone. Okay.
And actually, there's research that shows.
I'm an economist. I do, and that doesn't help them at all.
Unfortunately,
Great, thank you.
the thing is, there's actually research that says that for every resource or option you have over 10, you actually start to reduce participation in a voluntary program.
But that goes with a lot of things. Marketing guys have done this for years.
Yes.
Too many options, people get confused, they're walking away.
Yes.
Yeah, that's what I gather.
Okay. Thank you.
Good to see you.
It's good to see you.
See you again. I'll see you soon, David.
Sounds good.
Did I do okay?
You were awesome. Oh man, I wanted to record you for this.
Thank you.
No, you were not only your presentation. I'm telling you, I was having a hard time understanding what the hell those questions were. And it's like,
This one particularly.
what a way to start.
You know, it's hilarious. When I left Fannie, I took my little sabbatical, I was on, we had a new county executive in Montgomery County, and I was on this affordable housing task force. It's your fault.
Your answer, I do want to make something easier. That's sort of why I've shared for some of a lot of groups where they kind of go through this process of creating a small dollar. I will share now for you're right. Yeah, they go probably.
Okay, I can clear that. Do you want me to? Do you want a cup?
And then I think
I'll bring a cup.
it's
for her.
probably more appropriate that I sit there when she's talking,
Okay.
and then I'll come back up.
That's
What do you
fine.
think?
Yeah,
What do you think?
That would be good.
It's
Thanks.
a little bit more her stage.
Yeah.
You know what I mean?
That sounds great,
So I'm
Ray.
gonna just take this down. Okay, everybody, if we can start reconvening here. Let's all take our seats. The governor is a busy person. Are there folks in the hall? How's the hall look, Justin? Okay. All right. Well, good afternoon. And in case you weren't here this morning, I am Ray Boshara, a senior advisor at the Federal Reserve Bank of St. Louis and also a senior fellow at the New America Foundation, where I worked for almost 10 years. I have the real pleasure and honor of introducing Governor Sarah Bloom Raskin, who took office on October 4th, 2010, to fill a term that is expiring on January 31st, 2016. So she's just getting started. She's a member of the Board of Governors of the Federal Reserve. Prior to her appointment of the board, she was the Commissioner of Financial Regulation for the state of Maryland. Many of you may have been following her great work when she had that role for the state of Maryland. And there she was responsible for regulating all kinds of financial institutions, banks, credit unions, mortgage lenders, and servicers and trust companies, among others. And I think what really distinguished her work there was sort of being ahead of the curve in figuring out that we had a problem with some of these products and doing something about it very proactively ahead of some other states and setting a model for other states. I don't think it was an accident that she was appointed to the position that she's in because of her fabulous work in the state of Maryland. Prior to serving as the commissioner, Governor Raskin was the managing director of the Promontory Financial Group and worked on the Hill and for the Federal Reserve before and the Joint Economic Committee in Congress. She has 3 teenage daughters, and if there's time, I'd love some advice on that front. I've got 2 myself, one who just started driving. And, but I can certainly say that many people in this room, including myself, greatly admired Governor Raskin's work when she was in on the commissioner in Maryland, and we were thrilled to see you join the board. And we all very much look forward to your remarks. Governor Raskin.
Well, thank you, Ray, for that lovely introduction. I am very happy to be here. I see some old friends in the audience, and really am honored to be able to join you today. I want to thank the New America Foundation, the Center for Financial Security, and the Congressional Savings and Ownership Caucus really for the invitation to speak at this important conference addressing the savings and credit needs of Americans as our economy recovers. It really is a true pleasure to be with you here today. As Ray has mentioned, I'm the mother of 3 teenagers, and you know, as the mother of 3 teenagers who are struggling toward adulthood, and those of you who've been there or will be doing it, you know that's always 2 steps forward and 1 step back, or maybe it's sometimes a couple of steps sideways. But I inevitably think about economic inclusion from the standpoint of young people entering the workforce and the adult economy. And so I ask myself, what does it mean for them to be included in the economy? Well, obviously, I want them to be able to find satisfying, meaningful, and decently compensated work. Surely this is as much a marker of the transition to adulthood in our society as is registering to vote or earning the all-important driver's license. We might say that we're not truly included in the economy until we draw our first paycheck. One of the tragedies of our current lingering recession is that so many young Americans have not been able to experience the thrilling rite of passage that comes with finding a stable and decent paying job. And of course, even beyond the young, there are millions of Americans stuck in unemployment lines, desperate to find a way back into the productive economy. The question of employment, though, is not our focus today. But I do want to pause to underscore the promotion of maximum employment imperative of the Federal Reserve's dual mandate. I believe that this imperative has broad importance in American social and economic life. But economic inclusion also implies a kind of belonging and membership in the economy that goes beyond employment. In the financial and regulatory world, economic inclusion refers to efforts to expand public access to and participation in mainstream financial services. This effective inclusion in the financial marketplace depends upon a strong regulatory framework, active market participation, and an expansion in public financial literacy. For the sake of clarity, I'll call this meaning financial inclusion as distinct from economic inclusion, and proceed on the assumption that it is indispensably important to effective navigation of the twists and turns of life in the American economy. Imagine what it would be like, even with a job, if you had no access to banking or credit, if you didn't understand how mortgages or credit cards worked, or if you had no way to save a portion of your earnings. Sadly, there are millions of Americans lingering in these margins. In my remarks today, I'll share my perspective on why broad inclusion matters to our economic recovery, the challenges that current economic conditions present to the efforts of lower income Americans to participate in the economy, and the risks we face as a country if we understate or misunderstand these challenges. Let's first try to scope who is at risk of being economically excluded. So we start with the unemployed. The latest unemployment report issued by the Bureau of Labor Statistics was bleak. U.S. employers in May had added only 54,000 non-farm jobs, which was down from 232,000 jobs added in April. The headline unemployment rate was 9.1% in May, which represents about 13.9 million Americans out of work. Unfortunately, the headline unemployment numbers don't fully capture the true scope of the unemployment problem. There are an additional 8.5 million workers who are part-time of necessity or underemployed because their hours have been cut back or they're unable to find a full-time job. There are also 1.4 million additional workers who are marginally attached to the labor force because while wanting a job, they haven't searched for one in the past 4 weeks. And there are 822,000 discouraged workers who have given up searching for employment because they don't believe any jobs are available for them. So it's not just those who are currently collecting unemployment insurance payments who are excluded. The underemployed, the marginally attached, and the discouraged all of whom are primarily concerned about the security of their jobs, wage growth, housing, and the rising cost of living, are also suffering from exclusion from the economy of work. Most of these people searching for a way back into the employed economy are doubly challenged by their ability to access reasonably priced financial products with safe features that encourage savings. Americans have several core financial needs. They need a safe, accessible, and affordable method to deposit or cash checks, receive deposits, pay bills, and accrue savings. They also need access to credit to tide them over before their next cash infusion arrives. They may be coming up short, paying their rent, their mortgage payment, an emergency medical expense, or an unexpected car repair. They may want access to a savings vehicle that down the road will help them pay for these items and for education or further training or to start a business. And many want some form of non-cash payment method, such as a credit or debit card, to conduct transactions that are difficult or impossible to conduct using cash. Products and services that serve these core financial needs are not consistently available at affordable rates to all Americans. Those with low and moderate incomes may have insufficient income or assets to meet the relatively high requirements of banks. Americans without jobs, or with jobs that have slow wage growth, have little, if any, opportunity to establish a credit history that facilitates access to financial services. Others, especially in the wake of a recession that put many people out of work and homes, may have dents on their credit records that inhibit their ability to borrow on affordable terms. The economic crisis has undermined financial inclusion for many Americans. Low and moderate income families entered the recession with little financial buffer against the adverse effects of wage cuts, job loss, and drops in home values. According to the 2007 Survey of Consumer Finances, home equity accounted for 75% of total assets for low and moderate income families, which made them extremely vulnerable to the eventual housing market collapse. Sure enough, families in the bottom fifth of the income distribution saw an 18% drop in median net worth between 2007 and 2009, going from $8,100 in 2007 to $6,600 by 2009. Families in the middle of the income distribution fared even worse, experiencing a 21% decline in the value of their assets, which is the highest of any group during the same period. Combined with widespread unemployment, housing, and stock price declines, and increasing rates of mortgage defaults, foreclosures, and bankruptcies, the assets of many American families have been significantly eroded. In addition to losing the value of their savings and assets, a significant number of low and moderate income families have become financially marginalized as a result of the economic crisis. The percentage of families earning $15,000 per year or less who reported that they have no bank account increased from 2007 and 2009, such that more than 1 out of 4 families were unbanked. Families slightly further up the income distribution, earning between $15,000 and $30,000 per year, are also financially marginalized. 13% report being unbanked, and almost 24% report being underbanked. This combination of economic insecurity and financial marginalization has placed more low and moderate income families right at the well-lit front doorsteps of payday lenders and other alternative financial service providers to try to meet their financial needs. While alternative financial services may serve the access needs of many consumers, they often come at a much higher cost than traditional financial services. For example, the typical payday lender may charge $15 to $20 per $100 borrowed for a 2-week period, which translates into annual percentage rates often exceeding 390%. Similarly, check cashers generally charge customers 2 to 3% of the amount of a check, even for those issued by the government. So it's not hard to see how such fees can add up to several $100s per year, which is real money for any consumer, but as a percentage of income, much more costly for those with limited disposable incomes. For some consumers, these services may be seen as more convenient or customer-friendly than those offered by traditional banks. But this convenience comes with a hard price. It further exacerbates the precarious financial state of many families and in many cases locks them into a downward cycle of deteriorating finances. This is not to say that mainstream financial services are inexpensive. Free checking accounts are quickly disappearing, replaced by accounts with rising fees. Overdraft fees on checking accounts can also be pricey, ranging from $10 to $38, with a median fee of $27. These fees are not insignificant, particularly when applied to small dollar transactions. So the financial crisis in sum has left many lower and moderate income Americans in danger. With fewer assets to rely upon and deteriorating credit, many people find it harder to enter or to stay in the financial mainstream. In analyzing the state of economic and financial inclusion, the crisis both expanded the number of Americans excluded from the economy and dramatically raised the barriers to enter it. Well, why does financial inclusion matter? Well, broad financial inclusion is essential because it bolsters American consumption and savings, which drives macroeconomic growth. In order to promote efficient economic growth and stability, Americans must have safe and affordable access to the tools necessary to function in the modern economy. Congress created the Federal Reserve with a view that it should focus on economic growth, so the Federal Reserve has a clear interest in promoting a meaningful, broad recovery that is conducted in a safe and viable manner. Affordable, transparently priced, and safe financial products and services promote positive outcomes for individual consumers, which in turn supports the growth and stability of the overall financial system. From the standpoint of the individual, financial inclusion serves as a mild counterweight to the growing income and asset inequality in the United States that has deepened since the onset of the economic crisis. While the exact level of inequality is a matter of academic debate, the trend across various measures definitely suggests that economic disparity has increased over the past 30 years and has accelerated in the past decade. This phenomenon appears to be driven primarily by the rapid growth in income and assets for those in the top 1% of the distribution, while most everyone else has experienced stagnation. This inequality is destabilizing and undermines the ability of the economy to grow sustainably and efficiently. It is associated with increases in crime, profound strains on households, lower savings rates, poorer health outcomes, and diminished levels of trust in people and institutions. All of these forces drag down maximum economic growth and are anathema to the social progress that is part and parcel of such growth. These forces also bring people closer to being scammed or becoming vulnerable to financial schemes that promise quick and easy fixes. Finding ways to help more Americans safely grow their incomes and net worth in real terms arguably diminishes the destructive influence of income inequality by giving everyone a more secure footing in the economy and the same kind of flexibility and choice available to the more affluent. Understanding the impediments to inclusion for Americans will help policymakers to craft effective responses for expanding access to financial services. First and foremost, as I've mentioned, people need jobs with compensation that can support them and their families and that provide a source of savings and wealth accumulation. In other words, they need to be economically included. Second, we should examine barriers that individual consumers may face that keep them from being financially included. For example, a Federal Reserve analysis of the SCF data, which I cited before, suggests that the primary reason individuals do not have a transaction account is a simple lack of trust in financial institutions. This may originate from negative personal experiences with financial institutions, since more than half of the unbanked previously held checking accounts. For some immigrants, it may also be due to a more general distrust of financial institutions in their country of origin that translates to distrust of U.S. institutions. In addition to considering the barriers to accessing transactions, savings, and credit products, the discussion of expanding financial inclusion should consider new opportunities that have the potential to make financial services more broadly available. New technology, such as recent advancements in mobile financial services and the prepaid card industry, are spurring financial product and service innovation in the private sector. For example, mobile tools promoting ways to improve the financial capabilities of and providing new products and services for the underbanked are being developed. At the same time, there's interest in the use of prepaid cards that offer the payment ability of a debit card combined with the functions of a checking account to go along with an optional savings feature as a new product that provides expanded opportunities and options for consumers who don't have traditional bank accounts. New features, incentives, and discounts are beginning to flourish as the prepaid market expands and more competitors enter the marketplace. In fact, at least one prepaid card option encourages timely bill payment and savings by providing a discount coupon for prepaying a bill. For instance, a consumer with a $20 utility bill would get a $2 discount for paying the bill early, and that $2 would go into a savings account. Partnerships are another strategy for delivering financial services at a low cost. For instance, many of you know about the Bank On initiatives that are being launched throughout the country and are an example of how partnerships between banks, credit unions, local governments, nonprofits can lead to the development and deployment of low-cost products that are designed to meet the needs of low-income consumers. Bank On campaigns seek to provide pathways to safe, affordable financial products such as low and no-cost checking accounts that are offered by participating financial institutions. In addition to the wide range of work that's engaged in by the Federal Reserve System that is designed to foster and promote financial inclusion, the Federal Reserve System's community development function conducts outreach and acts to foster partnerships and provides research and analysis necessary to understand the challenges confronting low and moderate income individuals and households. By leveraging our strengths as a research institution through the network of community development staff in the 12 Federal Reserve banks, their 24 branches, and the Board of Governors, the Federal Reserve System is able to monitor and respond to changes in the financial services industry while positively influencing policy that affects low and moderate income consumers. So our collective work in the realm of financial inclusion is occurring within a landscape for financial services and consumer credit that many of you know is changing very quickly. Racial and ethnic diversification of the country presents opportunities for financial service providers that are attentive to the changing financial needs and preferences of consumers. Rising immigration from developing countries and the associated diversity of experience with formal financial services providers will challenge the financial services industry to be more flexible and creative in reaching out to consumers. Well, to return to where we began, which is teenagers, those of us that are privileged to share our days with them know how technology is absolutely central to their lives. Their familiarity and comfort with online interaction, combined with their expectation of immediate, continuous, and universally accessible service, will likely inspire changes to traditional models of financial service delivery. Traditional financial service providers that fail to keep pace with the latest technological innovations risk losing market share to innovators in this area. Signs that younger Americans are more tenuously attached to the traditional financial system are already apparent, and it is important for policymakers to understand the implications of this trend for the financial futures of the next generation. It may, in fact, turn out to be that innovations in financial services outside the traditional banking system will best address the needs of lower income Americans. However, it's incumbent upon regulators to ensure that these products and services are safe, affordable, transparent, easy to understand regardless of the provider. In some cases, regulators may need to ban products that are inherently unfair or deceptive. In all cases, regulators must ensure that consumers are afforded meaningful protections with respect to any products that are offered in the financial marketplace. Finally, regulators must also actively monitor the consumer financial market to guard against developments that might threaten the stability of the overall economy. To conclude, the financial crisis has created new challenges in ongoing efforts to expand economic and financial inclusion. The large numbers of unemployed and underemployed Americans are at great risk of being unable to access fair, sustainable, and affordable financial services. It's necessary for the strength of our nation's recovery that low and moderate income Americans be able to more fully participate in the economy. And both policymakers and financial innovators should remain committed to the imperative of building upon the progress that has been made. We need to be prepared to foster further innovation and outreach. Our overall economic stability relies ultimately on the collective financial health of all American households, so these are issues in which we all have a stake. One of the positive commitments that can emerge from this period of terrible economic distress is the determination that all Americans, regardless of income, have access to reasonably priced financial products and services so that they may fully participate in our nation's economy and safely build assets for their futures. Thank you. And I'm happy to take questions, Ray.
Yes, I'm going to help moderate the questions. We will do like we did in the last session, which is we're going to take 3 at a time. Please wait for the mic, state your affiliation and your name. You had a question in the last session. Justin, would you like to do that? Please.
Governor Raskin, I'm Justin King with the New America Foundation, and on behalf of all of us, thank you so much for being here today. It's really a pleasure to have you. That is, if I can be so bold, as full-throated an endorsement of an active consumer protection regime as I've heard in some time, and that may be because I don't listen enough, but I think that's not an unfair characterization. And I think sort of the bottom line point that you drove at is one that we've tried to make over the course of the last year and a half, and that is that there really is a symbiotic relationship between consumers and the marketplace, and the health of one is important, if not necessary, for the health of the other. And so we've tried to make that point over the course of the last couple of years. I'm very glad to hear you sort of make that point today. But there is a strong debate at this point here in Washington as to whether the steps that have been taken through Dodd-Frank are actually going to lead us to that point. And beyond sort of your remarks, which I guess I have endorsed already and wouldn't blame you for sticking for, what do you say to folks who worry that an active marketplace regulator is going to go too far and is sort of necessarily going to stifle innovation and close people out of the marketplace in unproductive ways?
I'm Lauren Saunders with the National Consumer Law Center. To piggyback on Justin's point about how consumer protection and safety and soundness are, of course, intertwined, even though we do have, a new Consumer Financial Protection Bureau, obviously the bank regulators also will have a continuing interest to look at consumer protection issues, from the safety and soundness perspective. And so I just wanted to find out what you view the role of the Federal Reserve and the other bank regulators is continuing to be in the consumer protection area.
Great. Okay. So, in terms of vehicles for new ideas in a deficit-strapped economy, where do you look for them? I think we should view this time in our budget history as really giving us the impetus to look outside of government for them. I think the extent to which we can be creative about forming partnerships and looking at developing, working with the private sector to develop products that work for particular groups of individuals, I think is the way to go. I think it's kind of crutch, frankly, to think that government is going to be there to spur this on. Ultimately, though, I think it's an opportunity, because I think we want something sustainable, and we want something that's kind of organic, that grows out of the economy and that is meeting the needs of people in various communities. So my instinct really is to work at the ground level, to create partnerships, to look for opportunities, to analyze the needs of various community groups, communities and neighborhoods, to see what kind of products are lacking there and what kind of products could be brought there and what the features of such products are, and then work with the private sector to essentially create those products, convince the private sector that those products would be, in fact, profitable, and that there's a huge swath of consumers waiting for them. And if only they were designed with those consumer needs in mind, they would have a perfect match and a new business line. I know it's not that simple, but it's I really hugely encourage the work at the ground level and with entrepreneurs. Two-track financial system, no, I am not advocating a two-track financial system. I would argue from an economic point of view that a two-track financial system is not sustainable. That essentially, if you have one track that serves the affluent and has high, checking accounts with high minimum balances, very high barriers to entry, that essentially new and more responsive market participants will emerge, and that they will emerge in safe ways and unsafe ways. And the idea here is not to keep them from coming out, but to see what it looks like when they do come out and harness what's good about them, and prohibit, limit, or regulate what is not so good about them. So I would hope that we do not develop a two-track financial system, but that in fact we develop a robust financial system that is responsive to various communities and neighborhoods in the country. Lauren, the question about the Federal Reserve's role in consumer protection going forward. So obviously many people know that Dodd-Frank requires a transfer of certain consumer protection functions from the Federal Reserve into the CFPB. And that transfer is ongoing and is proceeding in accordance with law. In terms of the role of the Federal Reserve going forward, I look at consumer protection in some of the ways that I talked about today. That is, it is essential, actually, to a growing economy and a thriving economy. And from that perspective, consumer protection is always going to be something that the Federal Reserve thinks about in all areas of its responsibility. So through safety and soundness regulation, through compliance, examination and regulation, and through considerations of how the economy is moving. Because I think it's one thing that is quite apparent now, that consumption right now is quite low, and it is not, in essence, the driver that it used to be for driving the economy. So the linkages between consumer spending and consumer finance and consumer protection, those linkages to the economy are of critical importance and will always have to be at the forefront of what the Federal Reserve thinks about. Thank you.
I believe Justin's going to be wrapping things up.
I do want to thank you, Governor Raskin. We really appreciate you coming here today. You're welcome anytime. You know, I can't believe, you know, you can think about this as New America is the place where you can come and no one will ask you about QE3.
And I would assume that that would be a good thing, but I don't know for sure. I want to again thank all the people who participated in pulling the event together today. Center for Financial Security, the Congressional Savings and Ownership Caucus. For folks who are interested in more information, this is a discussion that we really think needs to continue and needs to be a part of our public conversation. Regardless of what the big picture is, we really can't lose sight of the folks on the ground and the impact that not just the economic conditions have, but the policies that are in place have on low and moderate income families. And we're going to work to make sure that conversation continues here in Washington. So with that, I think we'll wrap up. If folks want to follow up, there's more information available at newamerica.net. And please don't hesitate to reach out to us and to the folks who are on our panels here today, because I think that this conversation extends much beyond the voices you heard from today, and I think we want to hear more from the folks in the audience. So with that, thank you all very much. We really appreciate it, and we look forward to seeing you soon.